So it's been a long time since we did one of these spaces. I've been triggered. I say, you know what, I can't take it anymore. I have a love hate relationship with this app. Um, they're just. It's really a shame that it's gotten to where it's gotten, insofar as I think the quality of the app, not just technology, but the content, what people are posting, the spaces, it's really gone downhill from where we were 3 years ago. And I find it kind of demoralizing, which is why I haven't done many spaces. Also, the content, I kind of go in fits and starts, and as I've repeatedly posted on to my account, I'm going to be migrating content over to Substack, and so Substack's free. Um, it won't always be that way. There'll be paid and free content, but I just am really frustrated with X, and it really is a pity. And so one could joke, let's make X great again, but as long as you got the clowns running this app, I don't think it's going to happen. I just don't think it's going to happen. So anyway, so why do this space now? Other than the fact I miss you guys, I've just been triggered by all the BS, the nonsense. And I finally got pushed over the edge on Friday morning. And I want to read something to you guys. I titled the space Democratization of Finance, Governments and Indexation No Bueno. I mean, what we have a market, but it's not really a market. It's a shadow of a market. It's really just become a casino. Um, and interestingly, maybe I'm the last guy on the planet to do this, but I just opened up a DraftKings account the other day, and I discovered online gambling, and I was like, oh, this is easy. You can blow yourself up, no problem. All right. So whether it's DraftKings, the online gambling, or it's zero ODGE, 0 day options, or it's all the crypto nonsense. I mean, the whole gamification of society, the gamification of the economy. So much for hard work. Let's all get rich quick. Get rich quick. Why not? And I don't want to get into politics, but clearly that seems to be the directive coming from Washington as well. By the way, sidebar, I'm going to get into it later. I'll trigger a lot of people, but I actually think the proliferation of all these alternative ways of blowing yourself up, online gambling, prediction markets, et cetera, I actually think this is probably one of the main reasons why uh, crypto in general and Bitcoin in particular are losing their luster. I mean, everyone wants a hot potato, a get rich quick scheme. And I'm sure this will, again, we'll get into this later, but the institutionalization of Bitcoin, which was hailed by most as a positive, is actually curiously enough a negative, because what's happened now is the volatility in Bitcoin has come down. And for all the people that want get rich quick, they don't want low volatility, they want high volatility. And so, people are bemoaning the fact that it's not really moving very much of late. And when you consider the last few months, you've had gold and precious metals to the moon. The market's been generally good, and Bitcoin can't get out of its own way. um, that's noteworthy in my humble estimation. So, but anyway, that's not what I'm here for. So let me read to you something. This will be brief, but this really kind of sums up my what triggered me, my frustration. So I was looking at Micron the other day, and this has got nothing to do with whether I think Micron's a buy or a sell. I was actually just articulating, yeah, powerful momentum in the stock. Estimates have been going up. Near term, there've been big price increases, and it's quite likely that estimates will continue to go up. But if you look over the cycle, usually buying cyclicals like Micron, when the PE is very low, the bulls will say, well, it's a new cycle, it's not the same old Micron, blah blah blah. Okay, fine, but history would say that buying Micron on 6 times book, 7 times book is not a good trade or investment. That there's a cycle to everything. There's mean reversion, and you should buy when buy straw hats in winter, not in summer. And so, If you're buying Micron now, and I'm not saying you should or you shouldn't, I personally do not own it. I missed it. But if you're buying Micron now, you have to believe that this cycle is different than prior cycles, because the history of semis is one of boom bust. And so nobody, I don't know how long the cycle's going to go. You don't know how long the cycle's going to go. What do we know? We just know what the valuation is and what's implied in the valuation. So that's the kind of the framework that I promulgated for thinking about what one should do with Micron, without expressing my own opinion. So I was looking at some articles, actually on CK Alpha, and I'll keep. I don't want to embarrass the fellow. I'll keep him in the Federal Witness Protection Program. But this, to me, just captures the essence of what's wrong with the market. Forget about whether you like Micron or you don't. And this guy, he's a prolific. He uses in the comment section. He writes, and so someone wrote a thoughtful article about how semiconductors are cyclical. Okay, fine. So then he responds. Um, Being up 200% is irrelevant to my thesis. Your thesis is irrelevant to me. So again, it's all about number go up, and people anchor on what their cost basis is. I mean, what your cost basis is irrelevant. What the stock's going to do is, my former boss Peter Lynch would say, Mr. Market doesn't know and doesn't care what your cost basis is. Just because you've made money in the stock doesn't mean it's going to go up, and just because you lost money in the stock doesn't mean it's going to go down. I remember Jack Nash, really successful investor. Jack passed away in recent years, God rest his soul, but I was managing money for him way back in the day. And he had a ruthless test that he would apply to his portfolio. And it's hard to do this. None of us can do this really, but you basically have to rebuy your portfolio every day, i.e., would you buy it here now? Okay. And the problem is when you own a stock and it's gone up, you might start thinking, oh, it's got good management, and you fall in love with momentum, all this other nonsense. All right. So just because the stock's up doesn't make it a buy or a sell, just because equally just because the stock's down. But momentum has become so powerful and has become the dominant driver for so many investment decisions now. So let me come on to what this guy wrote. So he's bragging that he's up 200%. And then he goes, your thesis is irrelevant to me. I don't particularly care how accurately you estimate Micron's valuation. And remember, all valuations are estimates. I care about the chances that Micron's stock price will go up versus down within the next 6 months to a year. Why? Because that's what investors always chase, and that's what strongly predicts price action. I think it's clear you are much more likely to be wrong about this than right. And he goes on and on and on. He talks about, yeah, it might look cheap, blah, blah, blah. But, this is just classic, okay? All I care about whether I think it's going to go up or down in the next 6 months. Okay, we know valuation is not a good indicator for short-term time horizons. I get that. There are drivers, what's driving the Micron price, whether it's, what's happening to the price of chips or PMIs or, the yield curve, whatever. You can correlate to all these things, okay? But he doesn't even offer a methodology. It all basically comes down to, is the number go up? And, anyone can throw crap against the wall and guess correctly. Kind of reminds me like when you're in high school, and you have to take a math test, and you put an answer down, and then the teacher might give you a bad grade even if you got the right answer, because they say, show me your work. Like, how'd you get to that number? I don't care if you got the right number. How'd you get to that number? And what's happening in the market, to me, there are a lot of guys like this fellow. They're just chasing momentum, and it's great. It's intoxicating when it works, but you're also going to be the bag holder that owns pets.com at the top. And so it's become all about price. It's become all about number go up. And it's just a complete casino. And so, I've spoken in the past about different parts of the market. There's the way I look at it, there's a dominant tech narrative, the AI stuff, which, has some fundamental justification. We can argue about the valuations. Then there's the crazy stocks, the meme stocks, um, multi-billion dollar market caps, no revenues, loss-making stuff. Okay, great. They're highly correlated to risk appetite. Fine, I get that. Okay, but those are just in their own little orbit. And then there's everything else. And the everything else hasn't actually been doing a whole hell of a lot. It's really been, everyone's focusing on the AI narrative and on the crazy stocks. And yes, if you look at the index, there's been big rotation underneath the surface. And one of my themes for this year has been you're going to see big rotation. I wrote about this in December. You're starting to see it now. But everyone wants their, 2021 back or 2024 back, where you can have all your meme stock and speculate. And that's fine, I guess, when if the macro environment's conducive to that, falling rates, increasing liquidity, the economy not expanding, so that much earnings growth. I get that, but we're not in that environment anymore. And so this knee-jerk reaction, you see the first few days of the year, and you can just see it by looking at what's going on Twitter. The tone of the folks. Oh, awesome, and I don't know how to do these rocket emojis. Ron, maybe you got to show me how to do this or whatever. But it's just the same nonsense all over again. And okay, it's turn of the year, tech's all selling. I get all that. The bounce, a lot of the garbage, is bouncing. So Okolo goes from 135 to 70, and now it's, I don't know, it's 100 or whatever the hell it is. I'm just picking on Okolo as a representative example. The space stocks, you can go on and on and on. It's all the same stuff. And this too shall pass. So enjoy it while you can. It's just not investing. That's just throwing crap against the wall and seeing what sticks. So, I'm just calling out. I'm calling out a lot of the insanity they see going on. The indexation, which basically is completely destroyed price discovery. Um, Government intervention. Buying, and now the Trump the other day, and again, I want to be political, but and Melody wrote on this brilliantly the other day, and you know they're gonna he says, oh, we're gonna buy 200 billion of mortgage-backed securities. Forget about the fact that's really nothing new. They've been buying mortgage-backed securities. Someone pointed out they don't actually have the balance sheet. They got the permission to do it, but not the balance sheet. But it's just, you look at housing. Okay, the housing market's stuck. I get it. So people saying, well, we really should lower interest rates and this and that. Everyone comes up with all these cockamamie um, uh, suggestions. And I was astounded the other day. The CEO of Open Door, this is a company which should know something about real estate. He said that mortgage rates are being maintained at an artificially high rate. I was like, what? What? Mortgage rates. Now, wasn't talking about short-term rates, mortgage rates. And okay, the Fed controls the short end. But if anything, you could argue that mortgage rates are been artificially held down because of all the buying by the Fed. But and this guy is CEO of Open Door. So I just want to shake my head. So I think there'll be volatility this year. Yeah, great. Well, empty statement, bullshit statement. I think you just as whereas if you basically owned uh, Mag Seven, and I see Kantrowitz here. Kantrowitz done a great job. A lot of the quality growth stuff, and again, he was recognized as number one strategist this past year for the second year running. But he even him he's calling for broadening of the market, and so you already see it. I mean, Mag 7 is starting to lag. The market more broadly broadening out. Foreign markets, which handily outperformed last year, I think will do the same this year. Um, and I'm reminded when you look at Mag 7, what it kind of reminds me of when I was younger, as they say on X. I'm old enough to remember when. So let me tell you a story, boys and girls. Back in the 80s, I was managing an international stock fund. And so it was Fidelity's first foreign stock fund. I was right place, right time. First year I ran money professionally. Actually, I had the number one fund in the country. At any rate, Japan at one point, at its peak in the late 80s, got up to 66% of EFA, Europe, Australia, Far East Index. It's basically the non-US S&P, if you will. Japan got up to 66% of that index. 66%. Largely led by Japanese financials and real estate companies, because we all know about, how crazy the Japanese asset bubble became. And you had Japanese bank stocks, for instance. I mean, Cantor wasn't born yet, or maybe he was. You had Japanese bank stocks selling on 10 times book and 100 times earnings. Japan was 66% of EFA, Japanese financials, banks and brokers, et cetera, Nomura. They were 30% of the Japanese market. They were dominating the Japanese market in much the same way Mag 7 and Tech has been dominating the US market. So if you did not own Japanese stocks in that time period, you were getting destroyed by the index. There's just no way you could compete with the index. In much the same way, if you didn't own Mag 7 stocks, Tech the last few years, you couldn't. And there were okay, and see them at the drivers. Why was that happening? All right, the yen was strong, rates are going down, blah blah blah. Okay, fine. And it worked until those macro drivers changed, and the collapse was epic for ensuing decades. I'm not suggesting that's going to happen to Mag 7, but the point is, the point I'm trying to make here is, when you get to a point in the cycle when the index is pretty much making everybody look stupid. I mean, we do know that over time, active managers do underperform. It's not the point, but there are points in the cycle when a larger number of active managers are underperforming or smaller are. And when you get to the point in the cycle when the index is making everybody look stupid, that tells you something. So go back to tech, say in 2000. I can recall 99, 2000. Recall it well. Um, Tech made a lot of smart investors look dumb. Um, George Vanderheiden, who managed the Fidelity Destiny Fund, you probably never heard of him. Second, number two at Fidelity after Peter Lynch. Fantastic record. He was basically shown the door because he refused to drink the Kool-Aid and buy tech. Timing was perfect. I think it was beginning of 2000. Chuck Clow, who was the global strategist for Merrill Lynch, was basically forced out. Chuck now runs his own shop in Boston. Julian Robertson and Stan Druckenmiller both basically blew up because of tech. And it's funny because one was long and one was short. Julian was short the entire time, and then that combined with some other bad bets forced him to close his shop. I believe it was May of 2000. It's actually the best thing that ever happened to him because Julian did better post that with the Tiger Cubs, and he made even more money then than he had previously. Stan, on the other hand, is hilarious because Stan, you got to go watch his interviews. Hilarious. He freely admits it. Stan is the GOAT in my opinion, greatest of all time. And he even says now, he laughs about it. He goes, I gave in. I knew I shouldn't be doing it, but I did it. Basically, what happened was Stan did not own tech, and he could not stand. It's like when your neighbor's having a great party, you're not invited, and he just could not stand being on the outside looking in. And finally gave in. And I think he says, in the space of 24 hours, he bought like, I don't know, $5 billion worth of tech stocks. In at the top of my life and times by Stan Druckenmiller. All right. He says he knew it was the wrong thing to do when he was doing it, but he just couldn't resist. And I know it was exactly the top of the days of the top. And he blew up. And so what's really remarkable is you have two guys that blew up from the NASDAQ bust. One was long, one was short. Think about that. One was long, one was short. And I go back to the Japanese example I started to talk about, where Japan was 2/3 of IFA. All the active guys, fundamentally sound guys, were underweight Japan, and they were getting killed. I recall, and again, I won't mention names, but there was one friend of mine, a rival fund manager. He'd go on TV and talk about how massively overweight he is Hong Kong. Hong Kong was only 1% of the index, and we're triple weight. We're 3% in Hong Kong. Okay, great. Well, you still have nothing in Japan, and that's 66% of the index. So explain to me again how you're going to beat the index. At any rate, it was impossible to beat the market on the way up if you weren't in Japan. Just like it's for the most part been very difficult to beat the market if you weren't in Mag 7 and Tech the last few years. But once Japan peaked on the last day of 1989, Nikkei 38,000. And we're now today 50,000 wherever we are. But the market went from 38,000 to 8. I'm not saying that's what's going to happen now. But what I'm trying to say is all you had to do for the next umpteen years, if you were managing an active index, was be underweight Japan and just index everything else. You didn't have to be in pick stocks. Just index everything else. So right here, right now, like for instance, everyone can make their own predictions. But if you think that tech is going to underperform, either because increasingly the AI bubble, the AI narrative is going to increasingly call into question. There are a lot of concerns about the funding, et cetera, et cetera, et cetera. Show me the money, show me the return on investment, or you think we do get a broadening of economic growth and earnings momentum is picking up. And it's not that the tech stocks are doing anything wrong. It's just you don't have to pay up for earnings growth. Earnings growth not just scarcity; it's more broadly available, and therefore the 493 are going to do better. And whether you want to own airline stocks or home builders or drug stocks or whatever, those stocks will do better because they're cheaper. I actually don't think they're cheap, but I digress. The point of it is you don't have to tether yourself to 35% tech. And if we do get into a big downturn to tech, to outperform, you don't have to be that brilliant. Just don't own tech. In the same way it was just don't own any Japanese stocks. And so I think it's important to think about where you are in the cycle and what the drivers are for uh, various styles, factors, industries. And I think people have lost sight. And by the way, one thing I'll just point out on the Russell, and Kantrowitz done a lot of great work on factors and the whole thing. I also borrow heavily from Adam Parker. People are tempted to say, "Oh, look at the Russell. Look how cheap it is." Well, it's actually not the case. Yeah, we know it's outperformed. We know it's underperformed. Yeah, that we know. But what they don't tell you is, the earnings growth of the Russell has been a disaster compared to, say, Mag Seven and the tech stocks and even the S&P. So they're way underperformed. But if you actually look at the Russell and look at the factors behind that, be it earnings volatility, bad balance sheets, the number of loss-making companies in there. I think what is it, 40% of the Russell's loss-making, and you actually just decompose it into what's it made of. It's actually not that cheap. Yeah, Russell value maybe if you were to look at, but if you look at like Russell growth, no, they're expensive. So this knee jerk, oh, we got to buy the Russell. It's going up, dude. Look at the chart. It's breaking out. Yeah, I get that. And in part because it's about positioning. I think one of the easiest trades for a lot of lazy folks was long tech, long the Qs, and fund it with being short Russell. Well, if they're going to be buying, if they're going to say, you know what, we don't want as much own tech, tech's not looking so great, it's starting to break down. Let's sell some of our Mag 7. So we're taking down a long, then we got to cover our short. The short is the Russell and some of that stuff. So there's a bit of that going on. Last week on one day in particular, I was speaking with a smart investor, and he said, George, what do you think about the staples? Because you had like Clorox and McDonald's and all this stuff going up. And I'm like, I think it's just an unwind. That's all it is. They funded their longs with that stuff. It's not like, McDonald's is so great or things are getting better or Clorox or whatever. I think it's just all about positioning. And so I think once you again, everyone chases price, and it's just wrong. I like to paraphrase the line from Oscar Wilde. The apologies to Oscar Wilde. They know the price of everything, the value of nothing. And this is not investing. This is gambling. And so, all right. So that's a bit of a rant. Let's go to a couple speakers. I know we got Ryan here. Unicus, Lax, if you're around, please come back. So Ryan, good to see you. What's on your mind, my friend?
Thanks. It was interesting because I think one of the harder things for me this year was thinking about, kind of what you just said and, where things sort of are in valuations. And, like you, I probably grew up much more of a Ben Graham disciple than a true, momentum chaser and gambler. But I think that was, that was what really opened my eyes this year, is that I don't think the valuations matter anymore so much as the flows, because if you go back and look at a couple of different factors. So back in 2000, there was something like 7,500 ish stocks that you could buy, and now there's 3,500. So the increase in concentration and correlation with more money printing means that we've got more money chasing fewer goods. What does that sound like to you? It's an inflation of some kind, right? So now you've got everybody with higher concentrations, higher correlations. Now, somewhere in, if you look at the math, 2020, 2020, or excuse me, 2022, 2023, we had passive investing pass active investing for the first time. And once those passive flows took over for the active funds, this just sort of amplified the effect. And it's created this real structural fragility that is a reinforcing mechanism in and of itself. And it creates this multiplier effect because now the demand has become inelastic. And so for every $1 that goes into the index level, you're creating somewhere between $3 to $8 in value on something like SPY. And that money is not spread out evenly, it's distributed by cap weight. And that cap weight means that the big guys are going to continue to get bigger just because people have this passive investing. And it has to go somewhere. And where it's going to go is going to continue to be by cap weight. And so what you're going to have is eventually all of these large stocks are going to continue to get larger until, just like physics, they sort of implode in on themselves. And then it'll be an irreversible crash that you can't stop. Because once the outflow stops, the same mechanisms work in reverse. So you'll have, for every $1 coming out, $3 to $8 in value coming out, and it won't be spread out equally. And the big guys will go down faster than the small guys.
100%.
The party's gonna get really good before it gets really bad.
Yeah,
And
100%. And the problem, Ryan, you're spot on. And I guess what I push back to you, I totally agree with you. So that then leads to the question: the party's really good, but what we don't know, and how do you decide, Ryan? It's like, is it 11 o'clock and it's just getting good, and you're starting to feel a little bit good, or is it, and you want to leave early because you drink too much, or
right,
is it more like 2 or 3 a.m. and you've had too many to drink, and the women are starting to take their clothes off, but you're worried that the cops might be showing up, and with your luck, you'll stay too long, get caught in an embarrassing situation, and you'll get busted by the cops. So is it 11 p.m. or 2 a.m., Ryan? How are you gonna decide that?
well, I've tried to take my opinion out of it, and there's a couple of different things. So first of all, I think my example was, yeah, you definitely want to Irish goodbye before you're the guy cleaning up the empty bottles and puke the next morning. I see anywhere from 6 months to 3 years. So it kind of depends. And one of the things that you can see that structurally has happened, and for people that think that, we have a liquid stock market, I would argue if you go back and look at the quote unquote yen blow up a year or two ago in August, and you look at the April tariff tantrum, the VIX spike that we saw was something that we don't typically see outside of a banking crisis. Another example would be, I think it was maybe last summer, there was an earnings report where I think Microsoft and Meta came out on an earnings call after market. And within 60 seconds, the amount of money that was added to their market cap was more than the GDP of 75% of the countries on Earth.
Yeah.
Within 60 seconds. Like, to me, that's not a sign of functioning. So where this starts to get bad is to say, okay, well, what's going to cause those flows to reverse to a point that you can't stop them? And there's two potential triggers. And I think the first one would be, and I'm summarizing a lot of work here, but I think the first one would be if you had another 2008 style job loss where people aren't contributing to their 401k plans anymore. Or the second one will be, and this is probably the more obvious one, but it's a little harder to figure out the timing, is when enough of the baby boomers turn age 74 and have to start taking their required minimum distributions.
Right. That's all well and good, but like right here, right now, you think about what's getting the markets where we have. I mean, bond market's been, quiescent, rates up, rates down, but we're where we are, 415. It's neither super high nor super low. So that's been quiescent. The oil price is pulling new lows. Um, you know, earnings, we're talking about, and so the things that are driving the market kind of well behaved. And so I think it's a fool's errand to try to call top of the market. I really do.
Mhm.
And people trying to make index calls, I think that's stupid. I think what's really more interesting and profitable is trying to get the rotation down. And so again, if all you knew, I'm just making this up. If you, let's say you said hypothetically you have some good stories in healthcare and they haven't done so great over the last few years. Some healthcare's done great, of course, but you've got, let's say you think energy's bombed out, this, that, whatever. I mean, and things just kind of roll along. Yeah. So what you're saying is the water level in the bathtub won't go down, until the passive thing reverses. And yes, I agree with you. When it does reverse, there was no price discovery on the way up. There'll be no price discovery on the way down. I agree with all that. But trying to time that my way, I think is kind of hard. I think it's an easier, more profitable thing to try to figure out the rotation, be it sectors, factors, styles, countries, whatever. And so, for instance, to that end, I last year was pretty good. I mean, getting the precious metals call, the basin trade, commodities, all that kind of stuff. I still think that looks right. And there are parts of the market to me which just look, way out of whack, overcooked, and some of the meme stocks. There's this electric car company. I don't know if you've ever heard of it. It's got a 25 market cap, which to me seems very fanciful. I mean, go down the list. I can come with a lot of buys. I can go with a lot of shorts, and I think that's really where we should be focusing our attention. What would you say about that?
Well, I don't look. If you go back and look, I tweeted at the beginning of 2025 it would be the year of commodities again,
Yep.
and I did really well in that space. And I'm not saying that there isn't an ability to find pockets. Right now, I'm still looking for a lot of companies that have hard asset plays,
Yep.
because I do think that there's a chance that inflation starts to pick up again.
Sure.
You can make an argument one way or the other, but my point, without getting too much more elaborate, was that rotation isn't going to save you this time.
Agree with
Uh,
that. Agree with that.
this is just going to be different now. So if that's the case, then if the big guys are going to continue to get bigger, that's my question that I had to struggle with for months, was why would you abandon tech? Because the valuations don't matter anymore. All that matters is there more money flowing in than flowing out?
Ryan, there's one thing I'll say to you. Then I want to go to Cantro, and that is we all know that we're all human. Sentiment follows price. Everyone's a momentum, whore. Excuse me, French. And
Sure.
so if the Russell really starts going, and it's not, and then on the tech, it's not, Apple's been a dog lately, Tesla's been a dog lately. You can go down the list, right? And people, and then just look at the Mag ETF, right? And people are saying, oh, gee, that's boring. Like, I don't want that. Let me jump on the horse in the lead. It wouldn't take a macro downturn, just like it was, to cause that to happen. I just think the performance. I mean, those things could be dead money. Let's say Amazon and Microsoft and Apple just dead money. Oh, but hey, Ryan, did you buy that uranium stock I told you about? I mean, people will get FOMO. They'll chase the other stuff. So I think, but everyone's like, and the other thing too, I just had this visceral reaction. I don't know about you. It just triggers me. The number of people, oh, you got to index, indexation, yada, yada, yada. And then you look at the record amounts of money that flowed for all the reasons we know, and they're justifiable, the performance sucked, the fees are too high, money went from active to passive. I don't know, was it 800 billion last year? I can't remember the number. But, people have a way of chasing performance. And so if you start to see these things underperforming, and people are going to be like, wait a second, why do I own this index fund, which is, 40% tech? Just like I go back to, I talked to you before, the Japanese stocks, right? Why did I index my Japanese portfolio? Wait a second. I could have bought some Korean stock at 8 times earnings. Like, why wasn't I doing that? All right. And so that's kind of the scenario. I guess what I'm saying is I can solve for X. X being like how these index stocks or indices aren't going to do that well without a generalized downturn. I just think it's about the rotation. So we're not disagreeing. We're largely in agreement. I just think it's a little more subtle than just calling the index. So, Ryan, why don't you hang there? Let's keep moving here. I want to go to Cantro, and then we're going to go to Unicus. Hey, Cantro, good to see you, man. What's going on?
Hey, good morning. So I want to. A statement was just made by the gentleman speaking that money's going into passive, and the implication was that that's going to continue, and that's going to continue. Uh, the big guys getting bigger, and I think the implication was outperforming. Um, I want to hear an explanation of why a dollar going into passive means that these larger companies outperform, and why the impact is disproportional rather than proportional.
Kantrowitz, do you mind if I just post the documentation for you instead? It might be something that's better to read than to speak about.
Well, maybe just general, if you could generalize.
Yeah, sure. So essentially, it has to do with the inelasticity, right? So if you use something like Kaya's lambda and the Amun liquidity ratios, and you run those through there, you can see that because of the inelasticity and because of the illiquidity, it creates the condition where those multiplier effects take place. So there's some math that's hard to translate into English.
Okay. All right. So
I'll post a graphic underneath.
Yeah, I know what you're referring to. Stuff that Mike Green's been highlighting. That basically a dollar coming in has a more inelastic impact on larger names. Is that's a general
Yeah, and there's
gist
a lot of working papers on this theory that go back to 2002. He and I have actually spoken about it before.
Yep.
And it's not necessarily a new idea, but I've been able to create some code recently that's been able to run a lot of this stuff that I think actually proves that it's probably true.
And I could just say, going back to the Japanese example, just common sense. I mean, in the Japanese example, it's easier, I think, third person where no one's got any skin in the game. You'd have stocks with a 10% float, let's say, and then other stocks compared to a stock that's got a 75% float. All things being equal, which they never are. If you just had a dollar going into one versus a dollar going into the other, you can readily see what would happen. And that was the case with the Japanese market, and it worked great on the way up because there's no price discovery; it's just all automatic. And the car reverse going on the way down. And again, there's nothing new under the sun. So, yeah, I mean, so Ryan, if you could post, I'd like to see that paper also. If you could post that in your feed, that'd be great. And we can all read it. But I think it's a really interesting point you make, Ryan. So,
Well, I guess
go ahead.
the S&P indices are all float adjusted, and have been for a couple decades. And I guess the thing I struggle with, and again, I've seen that, I hear it, but at the same time, what you can also see pretty clearly is if you're looking at equal weight versus S&P, within or large versus small caps, you can't reject the idea that relative earnings are also explaining relative performance. And I think, like, if you look in the last 3 months or so where small caps have outperformed, we've also simultaneously seen the longest period in the last 5 years, well, I guess 4 years, of small cap earnings outperformance as well, incrementally at the margin. So, I've had those same conversations with Mike, and in a way, I think for me to believe that, I guess, you'd have to see the relative earnings of large caps underperform and those stocks still outperform, which hasn't happened. Does that make sense?
Yeah, I don't disagree. I think you can have periods of that without blowing up the entire thesis. I'm not sure how he would have explained it, but I would explain it in a way that also, in a sense, goes back to proving the inelasticity of it. Because when you look at how the reaction to those earnings reports comes out, again, I was using the example a little bit ago about how Microsoft and Meta, added that huge amount within 60 seconds. We've seen the same thing with earnings misses. And so, I think if the small cap stuff, there are people who are, in a sense, chomping at the bit to do that, to where they're waiting for these rotations to take place, to where they're waiting for the small cap stuff to come online, and you're going to see the jump up in temporary measures. But what you're probably not going to get is a large adjustment in target date funds. You're not going to get a large adjustment in the average person who puts money into a 401k is not going to go back in and reweight their portfolio towards small caps to chase momentum. the momentum chasing happens mainly by the active managers. And as there's been fewer and fewer active managers over time, especially on the value side, right? The value side guys since ZERP have gotten killed, and a lot of that stuff gets out of the business. And those were the volatility dampeners, right? So when you start to look for, like what George was talking about a minute ago, that this stuff seems, on a cheap basis by, standard statistical measures, historical norms that we would have looked at, and then you start getting what you were talking about with the earnings updates coming through, you start to say, okay, this starts to make sense. Why wouldn't the momentum pick up and pick up on these small cap stuff? But I think that goes to prove that that's where the problem lies, is that's only going to happen on the margins.
Yeah.
Yeah, but if you have that constant force that never changes, won't all the essential change in relative performance be explained still by whatever is changing, even if it's a smaller piece? Like you're still
Okay,
going to see.
I think that's fair. I think there's some fairness to that.
And maybe it'll be more magnified and volatile going forward. But again, to me, like we haven't really seen a breakdown in just, again, earnings explaining a lot of what we've seen in Mag 7, right? The Mag 7 earnings have gotten much larger, and you're starting to finally see that incremental change, though, in the last few months level out, and it's being reflected in the market. We'll have to see if it continues, and we actually have like a good example of an economy that broadens out. And if you still don't see, the relative performance follow that as it typically does, then I think that the papers you're pointing to and the discussions become a lot more interesting. But I would say we've yet to see that, though.
Yeah, one of the things you can start to do is you can just take like a simple equation of taking, and I do this. I just take SPY minus RSP and divide it by the 200-day moving average. Or excuse me, the number of stocks above their 200-day moving average. And you can see, when you get into these periods of fragility where that broadening out is not following through. And then you can do the same thing with small and large cap stocks relative to each other. And despite, small periods of relative outperformance on the small cap stuff, when the inflationary and flow pressures kick in and the inelasticity kicks in, you will start to see that stuff give you diminishing returns, at least from what I can see.
I mean,
like until just 6 months ago, I didn't believe any of this stuff. I really didn't. I had to change my whole theory.
Yeah. I'm saying one of the important things on the last 3 years, though, there's been no relative performance outside of large cap in terms of relative earnings. Large cap earnings have been just going straight up relatively. So, the last, 23, 24, and the first 9 months of 25 aren't good sample periods because, again, the earnings suggested you should not have seen a broadening out, and we didn't. We saw these short-term pops, which were kind of event-driven based on interest rates or inflation data. So, I think, this year could be a good test against that thesis to see how much of an impact it actually has if you have the prerequisite of broader markets, which is broader earnings.
And I would agree with that, because that is, we can't go back and really understand the same mechanisms through a historical lens, because there's a couple of different things that haven't happened. Like I said, I think, and it's kind of tough to work out, but somewhere between 2022 and 2023 is where some of those mechanics changed to where the passive flows finally overtook the active flows for good. And then, I think in the short-term stuff, one of the other things that's very difficult to explain away is, the absolute explosion in the options market and how, that has had an effect on things.
Yeah. I think you guys both more in agreement than disagree. Yeah, and I would actually take the analogy also to the foreign markets versus the U.S. because, as you all know, the U.S. has a much greater composition of tech than foreign markets do. And so, in an analogous fashion, just like we talk about tech outperforming the S&P, you can look at the U.S. outperforming the rest of the world, and it's been going on since like I don't know 2016 or something like that. It's been like 10 years of basically straight up. Last year was the first year in many that wasn't the case. But it is true that, and you can't forget that, relative price follows relative earnings. And so you look at the earnings line for the US versus the rest of the world. You look at the earnings line for Mag 7 and tech versus the rest of the S&P, justifiably, I mean, those stocks did better because their earnings did better. Then you have the complicating factor, which Ryan, you were talking about. You then have all the passive stuff thrown in there as well. So remains to be seen. But if you're a fundamentally based investor, relative price follows relative earnings. That's just not every day, not every week, not every quarter, but that's the way it rolls. And so we'll see. In any event, let's keep it going. So Lax, are you there? Unicus, are you there, my friend?
Yes, George. Good morning. I'm here.
Good to see you. What's on your mind? So one of the things we're all eagle-eyed for, people trying to call tops or this or that, has been credit. Credit means incredibly well behaved. Spreads are tight, but you've had some cracks in the armor, and whether it's First Brands or some of the commercial real estate or yada yada yada. I mean, we're all looking, and we're all suspecting, smelling that maybe private equity is going to have trouble, private credit's going to have trouble. So, what's top of mind for you in sort of the world that you traffic in?
Hey, George. Thanks for having me here today. And we sent a yearly letter to our clients, and what we focused on are two things. One is private credit, and the other one is data center. So we have been following this for quite some time. As most people know, we've been following the auto sector and the consumer credit sector for more than 3 years. And this year, we slowly shifting as we continue to follow the consumer credit and the auto sector. It's important to understand that all of this are interlinked. And when someone on the one of the other speaker mentioned about valuations, when it comes to data center, what's concerning us is the power, is the supply chain necessary for data center is very critical, and the power and the interconnection in terms of data center or the new supply chain, if you will. So the power is scarce, and I've been talking to a client this morning, is that the we spoke with the sources on the ground in and around Virginia. And what they did was our team who were there drove around and spoke to the people, the regular consumers, and the electricity prices have gone up 25% for them. And there are a lot of, one of the data centers that we are following, 70% is occupied and roughly 30% is idle. And that is because of the lack of power. And one of the speaker mentioning about the valuation in the tech sector, and this is how we think it's going to go. And we will be wrong because no one can uh, call a top in the market, and we are not trying. So, power is a scarce commodity when it comes to powering the data center. AI, when that we see that to continue into 2026. And that means AI becomes rationed. If AI is rationed, that means the market's implied growth curve flattens. When that happens, valuation suddenly will matter again. And that is one thing that we have been following. It's data centers being overbuilt and the amount of scarcity and the lack of power. And to switch gears, the second one is the private credit. And a couple of speakers were talking about the 401ks and the investments and TDFs. Our concern is the usage of the word democratizing the finance. That is the way we are seeing it is a very fancy way to say the private credits are not going to come out and say, hey, can you please be my or exit liquidity? They're going to say, hey, it's democratization of finance, it provides a political cover, access sounds so pro-consumer. The underlying structure loads with complexity, fees, liquidity risk, and these are all moving on to the households. We see private credit has it all over the commercial real estate. We see private credit aggressively funding the data centers. We see private credit is all over the consumer credit. And that is very, very concerning to us because for two reasons. One, the consumers, the regular consumers, people are dragged into investing unknowingly sometimes into the illiquid private credit in their 401ks. And somebody can ask, okay, so why it's in a 401k? They can say, hey, I don't want to invest my hard-earned money into this private credit that I have no idea of. Because it does not appear as in, hey, you're investing in a private credit fund. What it appears is it comes under TDF. So TDF, as people know, it's supposed to be the safe option. It's an all-in-one retirement investment that has an ability to automatically shift from aggressive stocks to conservative bonds or cash as you near your chosen retirement year. So, but now we are seeing in a sneaky way that private credit funds are the illiquid are dumped into the 401k under the guise of TDFs. So you have what can I say, State Street Global Advisors and Apollo announced its TDF strategy, giving plan participants, exposure to public market plus pool vehicle of private markets investment. Great Gray plus BlackRock plus Goldman Sachs also introduced the TDF. So our two main concerns, and if you see what's going on in our head, is that data centers, their lack of power, and that cascades down into the affordability concern for people. And we are entering with trillions and trillions of dollars of debt into 2026. And no one is talking about whether it's going to be paid down. Consumers are entering into close to 18 trillion in debt, and no one has a clue whether they are going to pay it or not. And as we enter, we were talking about this a lot, is that we are seeing an expansion and we will continue to see an expansion of lower K as 100,000 people who are earning 100,000 to 200,000, they are living paycheck to paycheck. They are cascading down into that lower K, and we see that further expanding. And their 401ks, odds are in trouble. They cannot afford the basic needs. The basic needs, as in we can sit here today and say, hey, electricity is fine, hot water is fine, everything is fine. But as the data centers are expanding, we are seeing from people on the ground that the electricity prices are getting unaffordable. Their
Right.
water is getting scarce. So that's our concern, George.
So Lex, let me ask a couple questions. By the way, just I'm laughing for a second here. Maybe I'm not the only one in this room, but just a branding or nomenclature point or question for you. When you said TDF, I thought it was you were saying TDS as in Sam. I thought, oh my God, we're going to talk about Trump derangement syndrome.
No, no, no,
I know,
TDF.
I know. But sorry, what does actually TDF stand for?
It's a target dated funds. It's a default
Oh, okay,
option.
okay,
Yeah,
fine. So just a friendly word of advice: say target dated funds. Don't say TDF because I think it's confusing. But at any rate, I think the point you raise about electricity prices. If I could just, I mean, I think that's becoming, a real issue.
yeah,
I was flagging that last summer already. It's become a political issue.
yeah.
And so I think it's probably people in both, why should we having our electricity prices, go through the moon just so someone can do a stupid Google search a little bit faster. I mean, so I'm with you. I think that's going to be a problem. But Lax, let me ask you, so it's all great that we have narratives, but actually when you look at the numbers, first I'll go to one anecdote and then I'll ask you a more broader question. Um, so there was that story a couple weeks ago about Blue Owl pulling out of some data center thing, I think was it Michigan?
Yep.
And they're one of the more aggressive players in the private credit space.
Yep.
Could you just talk about that a little bit, or any other stories that you've seen where there's been hesitation about funding certain data centers?
Uh, Let me grab my notes. The funding with respect to data centers mainly focused on getting approval among the local government. So what we are hearing is, yes, data centers are um, okay. For instance, in Virginia, property taxes appear to be completely waived for the people over there, and the data center is supposed to pay wherever they are building, whichever county they are building, they are supposed to pay a yearly fee that starts from anywhere in millions of dollars, 20, 30 millions to 500 million. The number is unknown, but um, a huge sum is being paid. And one would think that amount will be distributed uh, to the public in that area um, in terms of development of that particular society. But what we heard is that that money, no one has any clue where it's going. What is indeed happening is that property taxes are waived for the residents, but the electricity prices is twice as much, and they are also investing. So you see data centers investing in electricity, in modernizing the grid. The United States grid technology is very, very old. And what shocked us is that 10 years ago, you should have fixed the grid and then started all the process. So the things are happening in reverse, and we see. You mentioned Blue Owl. Blue Owl. One second. Um, Blue Owl's problem is not limited to data center. They have exposure to other. I don't know if it's first brands or yeah. I don't know if it's first brands or some other um, challenges that it had. I have to look into it and get back to you on that, George. I will post a link on
Right,
my.
but I guess the question is someone joked the other day. You're all aware of the phrase, the canary in the coal mine, right? Okay, well, have we witnessed the owl in the coal mine? In other words, is there more where that came from? And I'm not talking when we talk about delays or cancellations of data centers. You were talking about the regulatory side. Yeah, I get that, but I'm particularly curious about, have you heard anything? Do you have any sense of maybe private credit being less willing to fund this stuff? Is Blue Owl just the owl in the coal mine? That there's more where
No,
that came from?
no, because that's an interesting question. Is private credit hesitant to fund any more of
Right.
this? The answer is no. So we are hearing that, for instance, Blue Owl or other private credit, there are a lot of funds going out. They are exiting, and but also there are a lot of inflows coming in. As an investors at this point seem to not care about what's
Okay.
going on.
Okay. All right. So it's just a very important point, just so everyone understands. I want to understand. Everybody else wants to understand that so far there hasn't been there hasn't been so far. All for the most part, these private credit guys are willing to fund this stuff. Is that correct?
They are continuing to fund this
Okay.
stuff, yes.
Okay. Fine. Because the conspiracy tin hat guys are going to say, "Oh, look at Blue Owl. It's all going to get canceled now." You're saying no, that's not the case
No, that's not
yet.
the case
Okay.
yet,
Okay.
because
Okay. Okay.
one
Okay.
thing
That's
is, one thing, if I might add, is what's surprising is there were four or five private credit fund managers were being interviewed early in 2026, and they were saying, uh, we are clueless as to why everybody is making a big deal about first brands and other things. We are now at a AAA U.S. guaranteed bonds. We are not claiming to be safe, so we are a
Sure.
risky one. So I don't know why everyone is crying. And what that tells us is what it tells, which should tell every investors, is that private credit managers are normalizing the bad underwriting, and we expect that to continue into 2026.
Okay. All right. That's helpful. That's helpful. All right. So let's move on to an area maybe where you see some smoke coming under the door, where you think there is a problem. So you've written a lot, I know, about commercial real estate, but let's talk about autos. I know foreclosure rates are going, repo rates, whatever, it's all increasing in autos pretty significantly. But there's that stock which starts with the letter C, which has gone up a lot, but seems to be both bulletproof. So,
Yeah.
is there anything? So, what are you seeing in terms of? But you look at the credit more broadly defined. Everyone gets caught up in this credit card data, this, that, whatever. But broadly speaking, the data's okay. All right. So, where do you think there's a problem? Occurring or about to occur anywhere in the credit landscape?
That is a very interesting question, and I'm trying to. There is no. The answer is not, hey, it's going to blow up. The answer is we are analyzing the asset-backed securities, for instance, in the auto sector. We are seeing a rapid increase in modifications of loans. So the tricolor incident, I have to take a little step back and say tricolor incident would not have happened, and tricolor would have continued to do what it has been doing if JP Morgan didn't make the call to Fifth Third. So what I'm trying to say is everybody is okay with what's happening right now because no bank wants to be the first one to trigger the house of cards. So in other ways, we are seeing a modification increase in the auto and the ABS. We will continue to see that happen because no banks, Ally and other banks, are now willing to take the losses in their books. That's what our sources are saying. And there is a huge news CRE maturity wallet's going to hit close to $1 trillion. What we are seeing, and Melody and I have been talking about this, is that we are seeing that it will continue to extend and pretend. It is a scary notion to say out loud. Um, in reality, they have to take the losses. That means then everyone have to take the losses. So we are saying unless that the administration comes out and says, hey, you have to pay the bill and this and that, we are seeing they extend and pretend to continue, George.
So I'm listening to you, and I'm like, it's like, what do I do with this? I'm like, okay, extend and pretend. So the conclusion. So okay, so that's a prediction. So that's predictive. So then the question, what's prescriptive? What do I do with that? Well, that tells me if it's just based on fundamental narrative, whatever, there's just going to be more and more liquidity to paper this whole thing over. I mean, it's like I always keep saying for months now, you can't own enough gold, and everything you're telling
Yeah,
me
yeah,
says the same thing. We're
yeah.
going to continue to have this fugazi pretend bullshit. I mean, basically, but guys, let's go on to something slightly different. Isn't it true? I feel like I'm a lawyer. Isn't it true, Lax? Okay. Isn't it true, for those who watch Perry Mason, isn't it true that when you look at the broad credit data, because we're all just credit tourists, you're the expert. Yeah, you look at default ratios, you look at consumer obligation ratios. Forget about the narratives. Yeah, we all would love to see, oh my God, First Brands is blowing up, and Ernie Garcia is going to be next, and da 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 da. Okay, but those are all kind of, I don't want to say they're one-offs necessarily, but you look at the broader data, you just don't see it yet. And maybe, a few months from now, we'll get a lot worse. And yes, housing is blowing up as Melody, is described with the first the FHA stuff and now the cessation of the student loan holidays and yada, yada, yada. But like right here, right now, it's not a problem. Is that agree, disagree?
No, I agree. Okay, here's the thing. Okay, so we do not. we are very skeptical about the data that's coming out. I'm skeptical, Melody is skeptical. So when we say, okay, the data, you don't see this in the data, my counter question, with all due respect, is what data? So the datas are getting massaged. The modifications is pretty much a way to say we are hearing the consumers coming out to Ally, for instance, and say we speak to the wholesalers, and they are like, Carvana is coming and buying up all the cars. So I hear short thesis on Carvana, and I tell people, investors, to stay away from shorting Carvana. That's because of this is the exact reason. Fundamentals does not show what's happening in reality. The data are not right. It does not reflect what's happening. Unemployment is higher than what's there. It's not 4%. We look at U6 and that is 8.5 or 6, and you add 3 points over that, and that might take you closer. I'm not talking about the narrative, George. I'm talking about that we are not relying on the data because the
No, no,
data, yeah.
I understand it. Okay, but stay with that. All right, I'm not disagreeing with you. I'm just trying to figure this out. So let's say, so I agree with all that, by the way, because not that I would ever be a conspiracy theorist, but okay. But so you and I go to the same church on this, or synagogue.
Okay.
So if that's true though, but then take that one step further. You're Ally Financial or whoever, right? And you're the one making these crap loans. Okay, you're a commercial, you're a regional bank, all right? You know what the real numbers are.
Yes.
Okay. So how does that inform your behavior? And because it makes me think that you'll be cutting back if you're responsible, and at some point you're going to see that happen. So let's assume the data is incorrect, as you're saying. Let's, for the sake of the argument, right? What does that imply about what Ally is going to do? What they may have to report in the next quarter, et cetera, et cetera, et cetera. I'm just picking on Ally for just as a placeholder, but what does that say about what these economic actors are likely to do going forward?
They increase the originations. So the more
They
originations,
they they increase they increase them with to paper it over.
yeah, they increase the originations. So they,
Wait. So instead of putting the foot on the brake, they're putting the foot on the accelerator. Is what you're
okay, it's
saying?
a mathematics, simple, right? You, the numerator and denominator, they
Sure.
increase the origination, and that's what we were told by a wholesaler who, deal with buying and selling all the crap and also deal with the banks. So when things are very, very bad, and if you wanted to hide that the things are bad, this is not a conspiracy theory. This is coming from a wholesaler who deals with this crap every day. So to hide the crap that's there, you have to report it, like you said. If you increase the origination, give loans, extend, keep people longer in the
Sure.
cars, it doesn't come out.
All right. Hold it right there. Hold it right there, Lex. Okay. We need to get. Hold on. I want you to keep talking. This is great bear porn, but I want to get. I need Bob Coleman up here. Get your ass up here, Bob. I need Bob Coleman. I need Ross. Get up here. Who else? Marathon. I know it's West Coast, but if you can get up here, like I don't think, based on what she's saying, you can't own enough precious metals. So anyone who wants to weigh in on what Lax is, Lax, you're triggering me. You're probably triggering a lot of other people here. So stay here. So just hang on. Don't move. Just take a deep breath. Have some coffee. I'll let some other people talk. You can keep talking. Piccolo, you want to say something about this? Or Tuluberry? Either of you guys, you want to say something?
Man, I'm at a loss for words. I wish I had more to add, but scary times. The bubble keeps pumping.
It's like they say, more and more and more. MOAR, MOAR. Toluberry, you got your hand up. You want to say something?
Yeah, I'm actually enjoying the topic, but my question, I have a question, and it's kind of off topic, so I'm just gonna wait a little bit.
Yeah. Please do. I'm sure it's a good question, but I really want to stay on this thread because I think it's a really interesting thread. Eric, I know will have something to say about this. Hey, Eric, good to see you. What's up? Have you been triggered by Lax?
No, I actually agree with her.
Yep.
That's a
Yeah,
year
I
ago.
know you do. That's why I want you up there. So what's the investment? So you agree with her. So what's the investment conclusion that you see from what she's saying?
Well, I'm keeping, remember on the financial a year ago, I said long goal was the trade,
Yep.
and and I'm keeping it because there's no reason to exit it yet.
Yep.
You know, So because of all these factors, from money printing to geopolitical unrest all around the world, Trump is going to go at it, and if he loses the House, then the Democrats will go to impeach him again. We'll have a lot of circus around the world and a lot of instability. So it's the way to go. I would also talk about, we talk about the financial about the metals that are used both in the data centers, in the robots, in all the things that are upcoming. So you've seen copper going up, aluminum going up, even tungsten, as David Nikolsky has been talking about. Um, for these, there'll be a bid. We just have to check what is the price point where it becomes overextended.
Right.
Technically over the year, because they have been bid a lot. We still have a shortage in memory chips and what do you call it? The DRAM and the what do you call it? The non-volatile memory. And this, I don't know at what point they'll be able to recalibrate it. It might take a full year.
Mm.
I don't
So,
like
so, but again, so people coming away from this space, like, what do I do? And I always like to translate into actionable ideas. I mean, my take is you got to stay on the precious metals. Sounds like you're the same way, no?
Yeah, I don't see the reason to liquidate them.
Nope.
If we're long precious metals, what is the reason to get out? Okay, silver has had a big run. At some point, you take a breather and consolidate before the next leg, but that's no reason to panic out of a trade. I would
Yeah.
just until the geopolitical things stabilize, I see no reason to get out of it.
Eric, let me ask you one question. I mean, nothing. Listen, it's always difficult to make short-term price predictions. Forget about long-term price predictions. But are you all at all worried? I have to confess, I'm a little bit worried that it's one thing if you're buying gold or silver 6 months ago, a year ago, whatever. That's great. I did. You did fine. But are you at all concerned that you got some of the wrong people? You look on X and some of these places, guys who, couldn't tell you what didn't know anything about this stuff are now experts and they're all over the place on X. I mean, and the silver bulls, they're actually they're as bad as the Tesla bulls and as bad as the crypto bulls. I don't know who's the worst, but are you at all worried that you got some of the wrong people pushing this crap now in the short run?
There's a lot of hype, and there's two reasons for that. First, beginners, and second, those who use the momentum to sell a product. A
Yep.
lot of people do that for, to sell a product or to sell their advice or to this and that. And you got to be aware of those who, I call them clickbait people. You got to be wary of those.
Yeah, I don't know. I mean, listen, the mark, but you know what? The other side of it is I get in violent arguments with myself. So one side of it is okay. We hear you, George. We hear you, Eric. Long term, it's great, but it's 100%. Silver's 100% above the 200-day. Blah 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 blah. John Roke, it's extended. You need a profit. Profit taking, yada yada yada. The flip side of it is maybe these markets just continue to trade in a way where they don't let you in the same way that you go back a few years ago when Bitcoin gets on a roll, you can say all you want about it's overbought, whatever that means, but it doesn't let you in. And when you're dealing with a market where at least certainly with gold, supplies price inelastic. I mean, that's one of the things about crypto. You have endless demand, meaning inelastic supply. And that's one of the things about all these markets that makes me crazy. I mean, they'll pick on Bitcoin, they'll pick on some metal, they'll pick on some stock which has a small float, and they just drive the thing, taking advantage of the short term illiquidity. And so corrections are hard to predict. If you're in Ross, I'll get to you in 1 second. I think what's more useful, again, depends on your time frame. Like if you're going to buy this stuff right here, right now, and you say to me, George, where's it going to be a week from now, a month from now? I don't know. But where's it going to be 6 months from now, a year from now? I think it's going a lot higher. Ross, please weigh in. What's going on, my friend?
Hey, George, thanks for having me here.
Good to see you.
Yeah, good to see you too. This has been a great space. So to kind of go on that same topic of, I agree that the precious metals trade it's a hard one right now because obviously you've got every factor really in my mind that's, bullish for prices, but it's just been such a huge run up. But the flip side, I think, of this market where there is an opportunity, and it goes along with some of the stuff that Locks was talking about with there's a real infrastructure constraint in terms of energy and water on this AI trade that it seems like it's pretty much full speed ahead, at least for the next couple of years. I think the energy space is looking really attractive right here. And there's a few interesting
Ross,
angles.
Ross, Ross. Oh my God, you're my new best friend. Keep going.
All right, there we go. Yeah, I mean, it's the one area of the market that I've just been buying into, especially the last few weeks. The first angle, I think the one that makes the most sense to me right here is natural gas. And we had this weird dynamic in place with the US market, which was everything was set up for a very powerful bull market going into this winter, and you kind of saw gas starting to make multi-year highs above $5. And then, of course, what happens with it seems like almost every winter when there's a nat gas bull thesis is the weather just doesn't cooperate. And so we had extreme warmth in December, and it looks like we're going to get more in January. And so that's just caused prices to collapse, even though the underlying market is tight. You just can't get away from the vagaries of winter heating demand when it comes to natural gas at this time of year. But I think it's created a really good opportunity because the real underlying driver of what's making this market tight, if you exclude the weather one-offs, is that we've got a huge ramp up in LNG capacity happening this year. So I think we're adding something like 2 to 2.5 billion cubic feet a day of demand just from the LNG side of the equation, which is a pretty big number, one of the biggest additions we've had in years. And then the other part of it is this data center demand. There's just really no other alternative source to power these things in the next 5 to 10 years other than nat gas. And we're not going to see much of that this year. But like I said, the LNG is the big thesis for 2026. But then when you get into 27 and 28, you've got this huge wall of nat gas power generation that's been in the works for the last couple of years. And it takes 2 to 3 years to build these plants, but they're all going to start coming online 27 and 28. And so I just think this is a really good opportunity with you have the weather created this short term just sell off across the whole space. That's going to fade in the next couple months. And then we're going to head into this LNG ramp up this year, followed directly by the data center ramp up in the next couple of years. So I'm looking at names like EQT is the largest gas producer. And then on the pipeline space, One Oak is a great solid pipeline operator that's going to be building in all these critical areas that are feeding into the data centers. So there's two names. And then on the royalty side, there's a company called Blackstone Minerals, which is ticker BSM, that I think is another really interesting opportunity. It's you have to have the K1 because it's a partnership, so it's kind of annoying come tax time. But if you don't mind dealing with those, it's like a nice 9% yield right here. So I just wanted to throw a couple of those ideas. I think those could actually work really well. It's just one of the few areas of the market that
Yeah,
is not seeing any kind of.
yeah, Ross, you and I are we're like, and Bob, I'm getting to you 1 minute. So just hang. Yeah, Bob, hold on. I'll get to you 1 second. Ross, you're totally spot on. And by the way, we didn't get a chance to talk. You and I were together. I don't know if you knew it, but we were both at the Porter conference back in September, and I thought you were great. And I don't know if you heard my nonsense,
I
but
did.
anyway,
It was a crazy, so much going on that I think I missed you on the way out. But
yeah, you
yeah.
can find my speech. It's actually I put it up on. It's on my Substack actually. By the way, I urge everyone. I'm going to shamelessly shill now. Please subscribe to my Substack. It's free. I gave a speech at the Porter and Company conference end of September. You may say, "Well, George, it's an old speech. It's 3 months old." Nothing's really changed. I was pushing gold, precious metals, silver, the whole deal, railing away about Tesla, going off on meme stocks and Okolo, crappy on the bond market. And so, if you want to see me bring the heat, please, I just put that replay of the speech up on my Substack the other day. At any rate, Ross, I'm totally with you because I had to do a recording. This goes back to mid-December, and I hate these year ahead bullshit things. I refuse to do them, but they're like, "So George, what would you buy?" It's always about stocks, right? Forget about the market call. And so I'm thinking, well, gee, I've been on this gold silver trade, and it's kind of overcooked. But more importantly, everyone's talking about that now. I want to be clever, I want something different. And so, at process of elimination, I backed into energy, and I was like, everything's about risk reward. Like we never know what's going to happen, but we can assess what's priced in. And I said to myself, you know what? Hard to see I'm going to lose a lot of money in energy, and if lightning strikes, we can make a fortune here. And so, I'm totally with you. I'm intrigued that I really like what you had to say about natural gas as opposed to some other ways you could play this. But as you think about the whole energy thing, you think natural gas is the way to go rather than say the producers or oil service? Or, I mean, do you think the oil price itself is going to go up, or that's less interesting to you than just the fact that, and it may, but you just think the natural gas call is an easier call?
Well, actually, I do like the oil trade. So yeah, the one other way to play it, oil is tricky. But I do think it's one of those situations where you don't have a lot of downside, and you do have the right now, especially on the geopolitical front. I think last week it was a little bit insane for people to be expecting oil prices to have any kind of near term or even arguably a long term impact from the Venezuela production supposedly coming online. I think that was an easy kind of buying opportunity in some of the energy names that didn't participate. So what happened was weird last week was all the majors like Chevron and Exxon that are obviously going to be developing this stuff if it happens. And then the service companies got a huge bid, but then you saw the opposite on all the Permian producers because the thinking is Venezuela's going to take a bunch of market share from shale, and I think that was a big mistake. So I was buying names like Venom, which is one of the best royalty producers in the Permian. But I do think that there's a huge asymmetry there because there's a little bit of an oversupply in the market that's obviously been pushing prices down in the near term. But really, the market, there's not a lot of excess supply coming anywhere in the short term. US shale is starting to roll over. And then now you've got what I think is a very underappreciated geopolitical risk premium where, um, there's just as easily as Venezuela could be a great success story, you could just as easily see that situation backfire and you could see a big
100%.
disruption.
100%. And I think maybe you could just elaborate. I think you made a really good point, and it talks about time frames. So, crude itself, the commodity, that's a spot that lives in the present, right? But a lot of these energy names, I mean, just it's a discounted, it discounts the future, and so you could have energy prices doing like nothing for the next, who knows, 3 months, 6 months. And again, I have to put my tinfoil hat back on. Look, conspiracy theory, no doubt. There's probably a lot of jawboning going in the background between the administration and Saudi and whatever. So okay, so for the next few months, oil price stays down, especially ahead of the midterms, yada yada yada. But I think the market, in terms of the equities, is starting to sniff out. They don't. It's not about the next 3 to 6 months. It's about looking out beyond that. Would you agree? Disagree?
Exactly. And I think there's obviously a huge geopolitical situation that could happen in Iran, which is another one that could really get messy. Depending on, I mean, there's just the way I look at a situation like either a Venezuela or Iran is there's one way that everything goes perfectly right, and you start getting extra oil flows if there's some sort of peaceful transition of power. But there's probably over a dozen different ways the whole thing could unravel and turn into some sort of major disruption in the market. But then, but who can predict geopolitics? So I just kind of set that aside. But I would say that there probably should be a geopolitical risk premium in the market versus
Agree.
this
Yeah.
discount.
Agreed,
um,
Ross. And one other thing, just flesh out for everybody in the room. I read this, and I want to know if I read this correctly. Leave Iran to the side for a second, because we don't know how it's going to play. But in terms of Venezuela, Eric, I'll get to you in 1 second away. In terms of Venezuela, from what I've read, yeah, even if you push the button right now, maybe you could get it up, 400,000 or 500,000 barrels a day. That's about it. 3 to 4 million barrels a day, or where it was a long time ago. That's going to be 10 years out at the earliest, or whatever. So, to the extent the market overreacted, bought into this narrative, oh, they're going to turn the spigots on in Venezuela. Like, they may turn the spigots on, but not a whole lot's going to come out for the next few years. Is that fair?
yeah, exactly. I think even Chevron, their most optimistic take was they might be able to add. They said that they would be able to double their capacity, and right now they're at 2 or 300,000. So, and that's over
Right.
the next couple of years. So that's a drop in the bucket.
It's nothing.
Um,
It's nothing. Yeah. So to the extent that they sold oil, because that's all BS. And again, also I know you are as well, Ross, a big believer in, it's Stan Weinstein was used to say, it's not the news but the reaction to the news. So
exactly.
so yeah, I think like we're stress testing the bear thesis here. It's like, they got this Venezuelan thing, they sold off for a millisecond, and that was it. So everything's about risk reward, and I'm totally with you. I mean, energy, as I said, I was asked to be in December to pitch some stocks, and I wasn't very clever. I just said, hey, you know what? Just buy energy. Buy some Schlumberger, buy some. I gave a couple drillers, Valaris, offshore guys, Valaris, Tidewater, whatever. Vietnam's a great company. Totally agree with you. I'm particularly intrigued about your comments about natural gas. I think I got to do some more work there. Hey, stay right there, Ross, because we're not going to give this thread up. Eric, did you want to weigh in on the energy angle?
Yeah, well, especially for the geopolitics applied to it, because Venezuela has so little oil currently, it won't affect the prices very much.
Yep.
And by the time they actually do produce, if they manage to produce, the demand will already be really high in the market. So I would look at the geopolitics affecting gold more than
Yep.
oil as such,
Makes
if I
sense.
compare the two.
Yeah, makes sense. Makes sense. And by the way, and I don't know if Ross or Eric or anybody on stage, and Bob, we're going to get to you in 1 second, wants to weigh in on this, but I read a really interesting piece yesterday. And again, let's keep politics out of this, okay? Hate Trump, love Trump, forget about it, okay? I'm talking more from a sort of grand geopolitical perspective, because now they're talking about Greenland. Let's just stay with the oil first. I don't want to talk about Greenland because I go from the frying pan into the fire. But in case of oil, someone was right. It made a lot of sense to me. Yeah, we're taking them over or whatever. Someone say it's about the oil, it's about politics, whatever. But I said, no, you look at a bigger picture. If I understand correctly, China has been taking most, if not oil, of the Venezuelan oil exports, and ditto for Iran. They're taking the bulk of the Iranian oil exports. So if we control, Venezuela in uh, kind of cutting China off from that oil, and if Iran breaks the right way, cutting China off from that oil, and who knows about the Russian oil? That's been another place where China's been getting a lot of oil. China has leverage with all the rare earth minerals and whatever. So the sort of economic power or leverage that we gain against China, and China has a lot of leverage against us, kind of makes sense. And I don't know, Ross or Eric, if either you or anybody has any reaction about that. But to me, it made a lot of sense.
I think that's spot on. If you really look at what this, I think the motivation for Venezuela is it's you're right. China made some huge inroads into that country over the last couple of decades, and they went from importing no Venezuelan crude because they had to have it's a very specific blend. It's that heavy sour crude oil, and you got to have really specialized refiners to process it. And what China did over the last couple of really the last decade was they made a bunch of investments into Venezuela to basically curry favor and get in deep with Maduro, which they managed to do. And then they built a massive refiner in China, just built specifically to process about 800,000 barrels of that crude. And so that was a huge way for China to basically secure their energy infrastructure. But it also kind of they set up an illicit oil trade between Venezuela was sort of the hub between Iran, Russia, and China, just dealing in this sanctioned oil. So it was Venezuela was like a hub that allowed Russia and Iran to funnel sanctioned oil back into China. And so there was that extra component too. And there's estimates that about as much as 5 million barrels a day was coordinated through that shadow fleet, which the US has now sort of cordoned off. And you're seeing the real crackdown there with the US even going so far as to chase Russian flag tankers all the way halfway across the ocean to cordon off that whole system. So I think that was a huge part of what they're not telling you is that it's not so much about we need Venezuelan oil because we obviously have
Right.
huge supports of
Right.
shale. It's really about cutting off China, and
Correct.
that's why I think Iran is that next because you point out
Correct.
that's the
Correct.
real way that they could squeeze China and
Yeah. Yeah. 100%. By the way, Ross, I haven't thought about it yet, but I think you traffic in shipping as well in terms of tanker stocks because you have the shadow fleet and whatnot. I got to think about what that means for tanker rates more broadly. I don't know if you've looked at that at all.
Well, I don't know too much about the tankers, but I do think if that's really the big picture motivation here, and to me it
Yep.
makes perfect sense, then the one thing I think you really go back to is the oil price itself.
Sure.
Because you can just imagine like how pissed off are China and Russia going to be if they manage to somehow get control of Iran. And I think that that's what's going to cause some fireworks there is if we try to go in there and whether it's to push these protests in one direction or the other, or now they're talking about actually striking the regime. I just think there's potential for that situation to really go wrong and go haywire for at least a few months, if not years.
Hmm.
And so I think oil is one of those bets there's very little downside. Like you said, we've tested the bear case. We can't get much below 60, and there's really not that much excess supply out there. But if you start disrupting the flow of these shadow tankers, and then
Yep.
you get some kind of
Yep.
conflagration in Iran, I mean, you could see oil prices go crazy.
Oh, all right, we're gonna go to Eric and then. But I just gotta say, you guys are on fire today. This has been. I got a lot of people telling me DM saying this is a great space. It is a great space, and it's not me. It's you guys. Yeah, I'm hurting the cats. I get that, but this is just awesome. This, if all the spaces could be like this, maybe I'd do more of them. But I don't know. Whatever. All right, Eric and then Bob. Eric, you want to weigh in on this last comment about the geopolitics?
Yeah, so I agree with Ross there. And the slight difference is there was very little oil from Venezuela coming to China. They just replaced it from with some Canadian oil. And what really happens is that it's in the backyard of the United States. Trump wanted control of his backyard as much as he can, rather than foreign powers. There were also some Hezbollah people there and whatnot. So as he's working on Iran and all the proxies, he had multiple reasons and to go there, including Maduro baiting him, saying, come and get me, come and get me. So if you say this to somebody like Trump, well, he's going to come and get you when you get under his skin. So there's multiple reasons for that. But we are back at a stage of big powers competition on the planet. So he would like to have Greenland as well, just like Vladimir Putin wants to go get Ukraine. It's well known that China wants to reintegrate Taiwan fully in the mold, might even go into some of the southern Japanese islands that is very little talked about. But at some point, it may happen in the future. And so when Trump sees all that, he's like, okay, I got to secure at least my area of the world, the Arctic, where I want to have some security. He's looking at it from this perspective. I expect him to try to go more for deals rather than more intervention military,
Yes, Eric.
especially
Eric, let me
for
interrupt you there.
Greenland.
We're on the same page. Let
Mhm.
me interrupt you. I read something where I think Greenland has a population of 57,000 people,
Yeah,
and they said if he offers them every citizen 100 grand, that's like 5 billion, right? Okay, and someone said,
yeah.
okay, five, I don't know, how about 250 grand, 12 billion.
A million.
It's
Yeah,
there's
even a
million.
million.
It's not. It's nothing. It's
Yes,
nothing.
absolutely. It's like free. It's like you
Yeah,
take it
so
if they
so
give it
so
to
I
you.
haven't seen any CNN polls on Greenland, right? But like everyone has a
Yeah,
price. I mean, if the Greenland inhabitants say, okay, we're all going to make 200 grand off of this, like why not? It'd be like the Louisiana Purchase, just buy the thing.
exactly. They can even pay 1 to 2 million each. It'll be 50 or 100 billion
It
compared
doesn't
to what
matter.
is
It doesn't
printed.
matter. It's about hundreds
Exactly.
of billions of rare.
It's free money.
And by the way, but I read something else, Eric. I don't know if you read this as well. It's not just, and this is a great piece I read this morning. It says it's not just they have the rare minerals. It's not even that. It's the processing of the rare minerals, right? Because it's dirty, it's hazardous, all this kind of crap. And if you can do it in the middle of nowhere in Greenland, like that's a much better deal. So no, I'm totally with you. So
Yeah.
like it's
There's
crazy. I mean, the thing is, we're talking about along financial lines, and we keep the politics out of it. But you look at the mainstream press, everyone's like, "Oh, he's crazy. He wants to invade Venezuela, and he's going to Greenland. What's going on?" From an economic standpoint, though, leave politics out. It makes total sense.
makes total sense. Where it is more delicate is that because Greenland is part of Denmark and European Union, if they do branch out, even if they do totally pacifically, make a like a what do you call it, a referendum, and they decided to go to with the US, then it raises the question for Scotland, for Barcelona, Catalonia, and other places in Europe. So for the Europeans to deal with that will be a bit more difficult. They will not want to let it go. There's another consideration here is how close are they together? If Greenland belonged to France, there would be no talk about annexation because it's a nuclear power. But because Denmark is not a nuclear power, there is talks about annexing
Yeah,
it. Will Macron put any nukes? If
yeah.
it was Charles de
All right,
Gaulle, he would have
all right,
immediately sent them. But
all right, all right,
still,
all right,
Greenland has to
all right,
accept. Here
all
in this
right.
case, I don't think so.
All right, we've gone down
Up to
this
you.
rabbit hole enough. All right, let's move on. I'm going to stop this space, by the way, at 1 o'clock. So we got 23 minutes. It's 2 hours. It's more than enough. Bob, you've been patiently waiting. So you the man. You correctly called all this. You were warning about the squeeze. Everyone's got to follow Bob. He's very mild mannered. He's not promotional like all these charlatans who you hear. He doesn't come on those late night TV things with 1-800 got gold. Blah blah blah. So he's an honest. You literally are an honest broker, literally. So Bob, you called it. We salute you, but you're only as good as your last trade. Talk to us, Bob. What is going on?
Sure, I appreciate it. Thank you, George. Yeah, this this industry reminds me a lot. I've been in the business since 1992, so I've seen a lot of these bubbles. and what you're seeing in the metals markets right now is very similar to, the Bitcoin run up, the tech stock run up in 99 2000. But just to kind of, just one quick comment on the geopolitics. This is what we're kind of doing with energy is very similar to what we did to Japan prior to World War II, almost, where we try to blockade and stifle their energy, or oil imports, to curtail their economy. And you can almost make the case that this whole geopolitics has turned into basically the board game of Risk. Where everyone is trying to capture continents to get the extra armies, and then load up and try and take the next country next door. But it seems like this world is just getting more regionalized, which is actually going to be promotional for the metals, because it's going to create more distrust, and obviously, the old adage, if goods don't cross borders, armies will, type of thing. So I think from a standpoint of uh, uh, trying to see the bigger picture, you continue to get, even though these metals are running up, and I'm purely on the physical. I really don't look at the mining companies. I don't play the game of, hey, listen, we're it's a complete shortage. We're running out of metals. You got to go ahead and buy. And the industry is just jamming premiums right now on the consumer. And the spreads are just widening out, and the bids are terrible when people are selling back. A lot of these big online dealers are paying $5, $6, $7 under spot for 3.9 fine silver. The consumer is just getting absolutely bludgeoned. It seems like, and this is part of this unregulated type of atmosphere that the physical world kind of deals with. But I think from a standpoint, if you just focus very very simply on the markets, we continue to see on every pullback, tightness start to form. So every time we see a sell off, the London spot market goes into, or the March futures, like we're in March futures right now, in the lead month contract on silver, continues to go into backwardation on every pullback. So there's still capital flow coming into the sector, and that capital flow is buying, for example, ETFs, that type of thing. And that demand for ETFs then goes ahead, and authorized participants go out and buy silver, and you see this tightness continue to develop. It's starting to loosen up a little bit because you're getting metal moving from New York over to London, and you're seeing millions of ounces, just basically flow to the area where it's needed, and that's where the pricing mechanism kind of starts to normalize. But that's been the story all through 2025. It continues into early 2026. I think TD Securities, or TD Commodities, they were very right about the silver squeeze, and I think they called basically a top in silver at around 50, saying the squeeze was over. Then they went short silver with a stop at 93. So basically, probably where the stop is going to get hit, because usually when TD goes into a trade, especially on the short side, they ultimately gets stopped out. It seems like I've been following their work for some time. So 93 I think is also the top of the Fibonacci extension. Once you get above 93, it's no man's land. But so just trying to keep it simple. I think we still move higher. We're in this melt up phase in the general markets. Trump obviously is trying to push asset prices higher. They're going to try and push rates down, print more money. The Fed obviously jumping in 40 billion a month. All the stuff you've kind of mentioned earlier, is still in play. So from that standpoint, I think we still move higher in the metals. The scary part though is this thing could go into a melt up, and then of course all the charlatans and dealers and promoters are going to say, if it gets to 100 or 120, they're going to tell you it's 200 or it's 300. They're going to keep ratcheting up those numbers, and this is where that part will get really crazy.
Yeah, Bob, very well spoken. He's not here today, but what's his name? Unicus. What's Jack's screen name? I can't even remember. Just another guy or another value guy, whatever. He was talking in his space the other day about is this one crackpot Asian silver guy or something? You know about this guy, Bob?
Basically it's an AI thing. And so what's permeated, about 2 weeks into December, or 3 weeks into December, somebody created this AI type of video, and it just started. What they do is they throw a couple of facts in there and then lace it with just lies, innuendos, opinions. Just you want to talk about rabbit hole of rabbit holes, and so it's a marketing ploy. I don't know if it's someone in the industry that's doing this, but right now it's gotten to Kevin O'Leary is now an AI guy that talks about the metals. I mean, they're taking this industry has gotten really bad. And in YouTube, for example, they'll even take a George Noble, for example, put your name out, and then with you talking, your voice and everything, talking about how great the metals are. I mean, this is how bad it's getting. I mean, every time I do a post, I spend 5 minutes with imposters, delete or reporting and all this other crap. I mean, every time I do a post, it's like 3 or 4 new imposters just coming in and with my face on it. But that's the world we're getting into, and unfortunately in the metals markets, it's very conservatively minded, but unfortunately a lot of investors listen to the crap that you hear from dealers. The Bank of
Hey,
America short
Bob,
6 billion ounces of silver, they're going to
Bob,
blow up tomorrow.
Bob. Not everyone's going to get this joke. It's an inside joke between you and me. There's only 200 people listening. I don't know how many people hear it on replay, but all we need now is for three aces to show up pushing silver.
Oh my God. Yeah. I wonder how that mine in Guyana is doing.
Yeah, exactly. Hey, Bob, one last thing on this. For those trying this, keeping track of this at home, you were mentioning TD and whatever. Like, what? I mean, the big picture thing is, like we're going higher. I think we agree on that. But if anyone wants to time this thing, which I don't recommend, and I'm not talking about day-to-day trading, but say like in a multi-week view, other than and you can't even look at extension above moving averages anymore. The whole market's just gone like bid only. Should we just watch what TD says, or like what rules of thumb should we, if any, where you say it's a fool's errand, should we try to pay attention to figure out short term if this is a good place to be adding, or should I be cutting back?
Well, I did a post last week. I talked about how silver's basically in a channel. If you go back to November, you look at the 4-hour channel, 4-hour charts, it's basically when it pulled back to the low 70s from about 80, and I posted that channel, it held the channel perfectly, and it's rising back up to the top end of the channel. One of the reasons why the market sold off hard from about 80 back down to 72 or 73 was we're going through this rebalancing on the Bloomberg Commodity Index. I think there's another commodity index where the metals had such a strong year last year that there's about $6 billion of selling that has to come in and rebalance that index because the metals got too heavily weighted in that
Sure.
index. So a lot of shorts came in, they pressed the market lower, and then everyone was expecting, a massive amount of selling to kick in, and the selling was more organized, done on a trade average basis, whatever it may be. But what's happened is the shorts have been trapped again. Perfect. It's the same type of thing. We see this. I tell clients, if you remember the Nasdaq market in 99 2000, the move started in August of 99. It doubled in December of 1999. Everyone thought that was nuts. It can't go any higher. And then it doubled again between January and March. I think the metals are doing the exact same playbook where the move started right after Labor Day. It took off. You had, I think silver was up at 1.45% in the month of December, and the storyline is still with us, and you see the pullbacks, you see the structure still intact. It's not as extreme as it used to be, but you see the gamma squeeze, you see the VXSLV, the volatility premium on silver. Metals act differently than the general market. Volatility rises when price goes up. That's been the characteristics of volatility with the metals the last couple of years. So if you look at where VXSLV is, I think it's around 66 or 70, somewhere right around there. The high end VXSLV was actually about 120 back in the short squeeze of January 2021, where this Wall Street silver thing kicked off. So you still actually could see higher volatility, and that would mean a bigger spike maybe, or that rocket ship or hockey stick type of move. And that's usually very characteristic of commodities, is when they get into that hyperbolic move where it gets completely unsustainable. The promoters will be foaming at the mouth, but you almost got to be starting to sell into that, because the problem is when the markets pull back, I'm starting to see where wholesalers in the industry are now, we get into these waves where you get all buying or all selling. And when you get the all selling coming in, there are wholesalers that will basically stop buying metal, or they'll curtail that metal, or they'll widen the spreads big time, and you'll get tagged, with an extra dollar or $2 under spot when things start to go down, or when the selling really kicks in. So you got to almost sell on the way up, and that's what I try to help people try to understand. Try to remove yourself
Right.
from.
Okay, but and again, maybe this is a fool's errand. I mean, let's not let what do they say? Let's not let perfection be the enemy of the good. I mean, for those who are just like, what do I do? And I don't want to day trade this thing. Buy it. The worst that will happen is it'll go down some, but 6, 12 months from later, you'll come back and be thanking Bob that you bought it. But short term, you think? I mean, you said you put out a post a week or two ago. Short term, gun to head, you'd be buying it right here. Or you think tactically we're at the top of a range, or just say, George, it's a ridiculous question. I can't answer it.
I've been buying.
Sure.
It's to me, it's like with the metals, you got to think of it as dollar cost averaging. You're averaging up, and a lot of people, the retail public has been, they have been coming into the market. The FOMO's here. Everyone's like, the train's leaving the station. I got to be a part of it. But oddly enough, you do have a lot of people fighting this thing too.
Sure.
And I think in October, what you saw, the different structure than you had in October. In October, the market makers went heavily short. They were absorbing a lot of flow that was coming into SLV by actually, you saw a huge increase in shares being
Right.
shorted to absorb that flow. And you don't see that now. You see basically share creation, which is actually going out and buying the silver. So and that's supportive as long as the physical market is in demand. That's very difficult to read the physical markets, get actual numbers, because a lot of this stuff is delayed. You have to look import export numbers, all that kind of stuff. But as long as that's still in play, that is the win to the back right now. This is not like your typical
Sure.
stock or other type of commodity that all you got to do is read volume and charts and
Got it. Yeah. So
the paper flows.
yeah. Well, Jeffrey, hold on one second. A couple more questions for. Hey, Bob. Isn't gold? If you look at gold, though, gold, you don't have this. Gold is like owning treasury bills right now, like compared to silver. But like gold, you don't have that hyperextension. So gold to me looks very orderly and pretty okay. As opposed to like silver, it's like yeah. It's like in the stratosphere. Like, what would your view on? You agree with that, or disagree, or what's your take on gold?
Yeah. Gold is, you've had the World Gold Council come out with their survey. 75% of the central banks continue to say we're going to be buying over the next 3 years, increasing our buying, not necessarily decreasing. So that's supportive. Silver, I think, is the redheaded stepchild of the industry,
Yep.
but then you have platinum. Platinum is the adopted redheaded stepchild. I mean,
Okay.
that thing, if you want to look at volatility, that thing moves 100, 150, $200 every day. Anyone who tries to play that is just getting wiped out if you're on leverage.
Yeah,
This
but
is a market.
Bob, you just made the case. You were in the space at the very beginning, but I was talking at the very top of the like 2 hours ago about why I'm bearish on crypto. And it's got nothing to do with you can talk about risk assets are going up and gold is going up and it's proving crypto. It's a very simpler answer. This crypto stuff and this Bitcoin stuff, it's all for degens who want the VIG. They want the juice, right? Now, with silver and platinum and sports betting and prediction markets, dude, it's like the fact that you've had institutional adoption of Bitcoin, it's a huge negative. It's become a low vol asset. It's like, what do I need Bitcoin for when I can do silver or platinum? No.
Yeah, you're absolutely right. And we've seen this. You've seen this in your career, but numerous times where the asset classes get hot, the money starts coming in, you get the momentum, and then everything else gets thrown to the side until its
Sure.
day comes around. So this is right now the metals time to shine. And it just so happens you have geopolitics of Iran that potentially could be the next regime to fall. You see. China's going to react to this stuff, and that's why I'm saying this is like the board game of risk. China's going to say, "Listen, in our hemisphere, we have to control it." And the question is, do they look at Taiwan?
Yeah, and I think that also too importantly, we can talk about price and everything. Sorry to interrupt you. It's just my nature is. you think of the drivers though, like who are the buyers, who are the sellers? Okay, you just pointed out a minute ago, you said, 75% of the central banks say they're going to keep buying. All right. So central banks are still accumulating. All right. Um, trying to put an inherent value on this stuff is a fool's errand. And basically, all this stuff is just an insurance policy. It's store value, insurance policy against insanity of policymakers, irresponsible fiscal and monetary policy, the debt explosion. And, people say, so what would make, I'm gonna pose a question, answer it, and then ask you the same question. People say, well, so George, what would make you turn negative on precious metals? And I say, well, if we had interest rates, if we had real interest rates at, a level where money meant something, or secondly, if all of a sudden you had fiscal sanity prevailing and you started seeing huge deficit cuts. Well, I don't think we're going to see rate. If anything, they're talking about yield curve control and cutting rates and all this nonsense. So we're getting they're earning for lower rates, if not in nominal terms, certainly in real terms. So I don't see any prospect of rates going up to what I think would be a more accurate level. And then B, last time I checked, there's no constituency anywhere for any elected official to cut spending. So to me, those are like two of the biggest drivers out there. And I don't know, how would you answer the question I posed to myself? What would make you negative?
Yeah, well, I grew up in the business where if you can't write the idea on the back of a business card, it's not worth investing in. And right now, the U.S. government is the greatest salesman for precious metals, and I don't see that changing. I mean, you're absolutely right. They're not going to stop the spending. There's a mandate basically to maintain collateral values, housing markets, all that kind of stuff. Keep this game going because I think at some point we get into the melt up phase and it gets unsustainable, and then all of a sudden, then you get, I think, a big move down that could draw,
Sure.
a lot of asset classes down. But right now, there's just too much gamesmanship going on, with the midterms and so forth. We're trying to obviously, take Venezuela, use
Right.
oil. If we can manipulate oil lower, that's part of the CPI index that we can control in a way. Whereas obviously, the housing market's stagnant. They're going to try and obviously just try to stabilize the price, but by trying to juice down the CPI, I think, especially for midterms, a lot of people look at the pump, so to speak,
Right.
to gauge inflation. I think that's the game plan right here. And as long as that is in play, I think you can't fight the market. It's
Sure.
the old adage: you
Sure.
can't fight the Fed.
And then going back, maybe before you came in the room, Unicus was talking about what's going on in credit, and the numbers are all bogus and things are falling apart and blah blah blah. So they're just going to extend and pretend, um, which means to me more liquidity, more money. You go back to, as you said, the U.S. government's the greatest salesman for precious metals there ever was. Um, it kind of I cringe when I think about this, Bob. But I think you probably agree. And you probably can school me on this, but if anything, it'd be like, because I know you think it's crazy, and so do I. MMT, modern monetary series. See, we ran $2 trillion deficits. There's no problem. What's the problem, Bob? George, what are you worried about? It's like, oh, okay, we'll just do more and more and more. Okay, so to me, it's almost like they're guaranteeing a car crash because they're gonna keep on doing it until the thing blows up in their face. Which, I mean, I don't know. What do you think?
No, you're absolutely right. I mean, you just mentioned we could buy Greenland. I mean,
Yeah.
it's just money. You're just printing the money, and yeah, at some point the game ends. I think when basically the market says no more, and we're not going to fund the deficits.
But we're
We're not
not.
going
Yeah,
to.
we're not close to that. Last I checked, the 10 years at 4.15, and they're talking about cutting rates again this year. They're going the
Yeah,
opposite way. It's like, Bob. It's like you got a fire going over there in Idaho, wherever you are. Okay, and they're coming one of those blowtorch, lighter things for your gas grill, and just making it. It's just they're pyromaniacs. They're just making you look like a genius. It's like more and more and more.
yeah. I think the only thing that really could that could throw a wrench in this whole thing is actually oil prices actually reversing and starting to rise, and go up. And because I think at that point the genie's out of the bottle on inflation and it just takes off. and then it just takes the kneecaps right out from the market.
Ross Hendricks, please call your office. Ross Hendricks, please call your office.
Music to my
Okay, no,
ears.
which is just another reason why you got to own the energy, because in a way it's partially a hedge for this as well. A, you don't energy in its own right, okay, because Ross was making the case earlier. But B, it's also a hedge against your precious metals things. So, but don't worry, don't worry. I have a meme stock which is on 30 times revenues, which is on 25 times EBITDA in 2032, which I think is interesting. I don't think so. So like guys, anyone on stage, what am I missing here? Because like, and by the way, this space has just been on fire. You guys, all you, Unicus, Ross, by everybody. I mean, I haven't done any space for 2 or 3 months, and I would like to do more, but honestly, it's like I feel like I'm a voice in the wild, and it's this. If they're all like this, I'd do more. But maybe just got to do them on Sundays when people have free time on their hands. I don't really know, but so I don't know. To me, between what Eric said and Bob, what you said, and Unica said, and Ross said, all from different perspectives, all roads lead to the same place. What am I missing, Ross?
No, I think that's right. I mean, if we are in this inflationary money printing dynamic, then oil and energy is historically one of the best inflation hedges.
Oh, but
And
Ross, I just looked at the Trueflation data from last week, and it's only 1.94%, and so the Fed should cut next week. What do you think, Ross?
I would love to see the Fed cut and just go for it. Just throw all caution to the wind. Let's just barrel into the inflationary firestorm at full speed. Because I mean, I think that's where we're heading anyway.
100%. And you know what? They can hold the oil price down for a few months. I get that, but the market's looking ahead, and And by the way, I don't know how far you go on energy, but I follow Mike Rothman pretty carefully. Actually, and again, the problem, and this is true for energy, and Bob, I know it's true for your markets too. The ratio of the size of the paper markets to the physical market. I mean, energy, Bob, you'll tell me in a second. In energy, I think it's like 45 or 50 to 1. So if you actually count barrels and everything, you get a much different picture than just looking at the future stuff. But then in energy, Ross, I want your take on this. I looked at like commuter traders and stuff, and you probably forgot more about this than I'll ever know. But you see you see the commercials are almost net flat now. Like you never see that, all right? The speculators are like as short or as unlong as they've been in like years, and so
Yeah.
you're set up from a positioning standpoint, a sentiment standpoint, a valuation standpoint, a fundamental standpoint. It's just waiting for the fuse to get lit. What's your pushback, thoughts, comments, reactions on that?
No, I think that's right. So the speculative positioning is as stretched as you point out as we've seen it in years. And then if you just look at the investment community, nobody wants to own energy stocks because you
Yep.
can make 100% in Palantir in 3 months or whatever. And I like
Oh,
this rotation that we're seeing under the market. I think if I were to bet, I think energy is going to be the next part of the rotation trade.
yep.
People are going to just start. I mean, you see, there's just tremendous value in a lot of these stocks. Like I was mentioning, you can buy top tier pipeline stocks like One Oak yielding 5.7%.
But
And as
Ross,
far as
what
I'm
about
concerned,
space? You don't get it, Ross. I got my space. I see Cheech down there. What about space? My satellite stocks. Sorry. So Bob. What's the commitment of trade? Two things I want to ask you, Bob, about positioning. One, commitment of traders data, and then also the other one. You started to touch on this. A great chart from like 3 months ago, and I actually did this at the and again I urge everyone shamelessly showing, please go look at my Substack. If you want to see me totally crazy, just go watch the speech I gave 3 months ago at the Porter conference. I put a chart up which showed and Bob, I know you know this, you probably have it posted on your website, but I can't find it right now. The one which shows total ounces of gold owned by ETFs. And even though the price is to the moon, when I had this chart 3 months ago, it was still lower than it was, 10 years ago or something like that. So two questions about positioning. What do the ETFs look like? And then also what do the commitment of traders data look like?
Yeah, you're absolutely right. I mean, you haven't seen the flow come into well, silver's actually picked up pretty strongly in the second half of the year. So, but if you look at the managed money side
Sure.
and you look at the long side of managed money, their positioning right now is basically as low as it was at the end of 2024. So you don't have a lot of people chasing the market. And what I've always said, and I looked at the palladium market, I did a whole interview on this like 3 or 4 years ago. You had Basel III, you had basically a deleveraging that was going to start to begin into the precious metals world when Basel III was implemented. The metals market is acting very similar to what palladium did during its run up, where the commercial positioning as well as the speculative or managed money positioning both started to decline, and they did not participate as the market was going higher and higher and higher. And part of the reasoning, I think, behind all this is the carrying costs and financing costs continue to rise, which makes it more difficult, and the hedging costs and the volatility makes it more costly to try to play the game on the leverage side. So it's just much easier to play this thing on the physical or maybe the ETF side, which is quasi physical and cash.
So so from a positioning standpoint, we're still in a pretty healthy place, if I understood you correctly.
Yes, yeah, it's not like 2008 when you looked at the big deleveraging that happened in 2008. Traditionally a lot of money went into, the CTAs went into the futures markets. They played the contracts from the long side, and when you get these big drawdowns, they get wiped out because they're on leverage. Well, as you get more deleveraged, you're building a stronger market. The stronger hands are holding the stocks
Right.
at that point, and
Right.
I think that's been the last 2 years. That's really been the driver, and that's something I predicted about 3 or 4 years ago what would happen with the advent of banks moving away from unallocated types of programs where basically a client says, hey, I want to own gold. They go ahead and say, listen, I'll sell you that gold, but then you're really not owning gold, you're owning our balance sheet, and we'll just play the leverage game of buying options to replicate the price performance because we know you're never going to ask for the physical. Well, people are asking for physical now. Or you've had a massive increase in structured products the last couple of years, huge amount of business being created. So, and if you look at the derivative side on the precious metals, you've seen that massive increase in the Office of Controller Currency reports. So institutions are coming into this market, and SLV, GLD are two big ETFs that are indexed or used as indexes for a lot of these structured products as well. So that tends
Right.
to push more money into the options markets, and that option, it's a tail wags the dog scenario.
Sure. All right. One question for Bob. I'm going to ask you, Bob and Ross, the same question. I'll answer my own question first. So, and I probably shouldn't even do this, but I'm going to do it anyway. So when I think about gold and silver, precious metals, let's leave platinum. To use your description, Bob, let's leave the redheaded stepchild and the daughter of the redheaded stepchild out of it. Let's just talk about gold and silver. So one, it's spitballing. Like, where do you think this can go? Like, when you buy a stock, it's like you say, okay, I buy it because I think it's going to go up 25%, 50%, whatever. And, as the fundamentals change, you adjust your idea what fair value is fine. Gold and silver are kind of funny. They're not income producing assets, it's a store of value. We go through all the reasons why it's interesting. But when I think about where it could go, and again, Ross at the Porter Conference, I put up a chart. I showed Chris Wood, and Bob, you're probably familiar with these calculations. He had, because you probably you read more of the stuff than I do. He showed where the price of gold would be, adjusted for real incomes, adjusted for the money supply, blah, 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 blah. And it doesn't mean it's going to these numbers, but on one calculation, it was like, I don't know, 6,600, or another one, it was like 10,000. Who knows? The point is, like, I'm not buying gold. I don't own gold because I think it's got 10% upside, and we're going to be at 5,000 at the end of the year. And I think silver's going to 100 because that's a round number. No, I wouldn't put a price target on any of this stuff. I think it's open ended. I think, as we said earlier, it's a insurance policy against ongoing stupidity from central bankers, and it's a store of value, and endless supply of money and fiscal responsibility, and so on and so forth. But if you administered the truth serum, or in my case, gave me a good bottle of Pinot Noir and got me, pretty juiced up, and said, George, where do you think this can go? I have no problem seeing gold at 6,000, 8,000, 10,000. I mean, that's a kind of, and look, it may go even higher. I mean, who the hell knows? But like right now, right here, right now, like I have no problem with seeing gold at 6 or 8,000. I have no problem seeing silver at, I don't know, 125, 150. So in terms of order of magnitude, I mean, we're not interested in precision here, and also I'm not asking for a time either. Like they always say, give people a price or a time, but never the two together. But if I said to you, hey, you know what? By the end of 26, gold's going to be at 8,000 and silver's going to be at 150. Well, that's totally plausible to me. So I'm just going to put that out there. So first I'll go to Ross, then I'll go to Bob. Ross, how would you answer that question?
Yeah, I'm with you. I mean, there's no reason why gold could not continue to move substantially higher because it's just the inverse of fiat currencies, and we all know
Correct.
what they're doing with the currencies. So
Yep.
I think it's like you said, it's kind of silly to try to buy gold and sell it 10% higher. Like that's just there's maybe some traders out there that's their game, but I think it's almost like an insurance policy against just
100%.
losing
100%.
control. But the one thing I have been doing, and just not to continue beating the energy drum, but what I've been doing is progressively selling off a little bit and just rotating that back into just some high quality energy stocks, because I think if we're
Yep.
going into that scenario where we're just gonna completely run the fiscal wheels as hot as possible, and then you've also got the geopolitical upside, that I think precious metals have maybe been front running a little bit of this geopolitical turmoil we're seeing. I mean, energy benefits from all of that too.
Yep.
So I've just been
100%.
rotating a little bit.
Makes
Mhm.
sense. All right, I'll go to Bob and then Eric. Bob, what are your thoughts about the open-ended question? It's a simple question, but not so easy answer. How would you respond to that?
Yeah, I'll just mention one thing on the energy first, and then I'll answer that. Um, if you look at prior to 2008 financial crisis, silver basically an ounce of silver equaled about 4 gallons of gas. Now an ounce of silver is more than a barrel of oil. So you're seeing where silver is now basically starting to become more of an asset that's being watched by more and more people. It's starting to be more mainstream. And that's actually a good positive. It doesn't mean that it's overvalued right now. It just means that people are recognizing it more, and they're being more acceptance of that volatility, and saying, hey, listen, this is an industrial, quasi precious, quasi monetary metal. I think you're right. If you see 60 or 6,000 on gold, for example, I don't think silver is going to peak until you get to about 30 or 20 to 1 on the gold silver ratio. So let's say you get to 30 to 1 on the gold silver ratio and gold gets to 6,000, that puts you right at 200. I think that, that could be a logical step. Maybe in terms of an overshoot, if you do go that high, uh, people look at these ratios, these relative value ratios, and I think the white metals are going to play catch up, and they've already started playing catch up since after Labor Day. Platinum is another one where platinum traditionally is more expensive than gold. Platinum is like 20 times rarer than gold, but yet last year it got down to a point of 0.28 ounces of gold equals 1 ounce of platinum. It was just absolutely insanely. Platinum was very, very cheap. So yeah, the ratios can show you also a different way of looking at it, rather than saying based on money supply, based on interest rates, based on all that kind of stuff. You could look at just relative value ratios, and that would make sense.
Hey, we'll get to we'll get hold on. We'll get to Eric and then Michael wants to get in here. I got one thing. Hey, Bob, Ross, Ross, you there, Ross? Ross,
Yep, I'm here.
you know what we got to do? Bob's a nice guy, but I think he's got to get more relevant. So, what would you say? Like Bob needs, I think he needs a wardrobe consultant. So, how about like maybe he gets himself puts on a baseball cap, wears it backwards on his head, and then instead of laser eyes, what if we get a picture of Bob smiling and he should have like all gold teeth? What do you think? Okay,
Yeah, maybe a nice thick
Bob, you up
gold
for that?
chain.
Yeah, chain. Okay. And then just keep chaining number going. But you know what's really funny about this conversation? I'm trying to joke, obviously. You know what's really funny? Here it is, we're anchored in rational thinking, and we're trying to justify why I could go higher. And it's like and we're kind of like, oh my God, it's gone up so much. What do we do about this? But just think about the lack of concern and how unburdened they were. Kamala Harris, please call your office that the Bitcoin bro were with like, number go up, rationalizing $2 million a coin, have fun staying poor. I mean, you think about it, it's like if you got some of those degens and are running silver, since when does any of this rational thinking become relevant? It's like there's no telling how far they could push this stuff. I don't know, just an idle thought. But I think guys, I think Ross, Bob, anyone else on here, Eric, I think we need to change our avatars and all have gold teeth. That'll be a sign that we're all brothers in this trade. So, a big smile with gold teeth. What do you say, Bob?
Yeah, that sounds good. The laser eye stuff is just that's
No, don't no, Bob. But you know what? Do like gold teeth and like a twinkle in your eye. No laser eye stuff. No baseball cap. I think that'd be great for you. Be a good branding thing. Gold teeth. I'm sure you could figure out how to Photoshop to get that to work. Eric, did you want to say something, Eric? Eric, did you want to say something or not? I don't know if Eric's still there. Can't hear you, Eric. Um, Gnostic. Hello, my friend Gnostic. Good to see you. What's up?
Hey there. So just to be a devil's advocate, and just because sometimes I'm a prick, what could cause gold to fall?
So I think you've only been in the room a few minutes. I answered that question, but I answered that question. I answered it myself, but that's a great question and we'll do it again though. I said, and I can't remember if it was Bob or Ross just said, fiat gold's the inverse of fiat currency. So if the value of money starts going up, the value of gold will go down. If you had there was a breakout of fiscal rectitude. If they stop printing money, I mean, those are the most likely scenarios that I can imagine. Now, of course, a generalized wipeout in markets and asset prices will cause gold and silver to go down, but that'll probably be last man standing. So I don't know. That's how I answer the question. Bob or Ross, do you want to have another crack at it for Gnostic?
Yeah, I think you're right. You could get the general market sell off, the leveraging that comes into the market. The one thing, gold and silver are not a U.S. centric story like 1980. This is a global story where it's not just simply, hey, the U.S. investors are going to start selling, so therefore we control our destiny. I mean, you have India, which is an enormous buyer of physical metals. China obviously has been a big buyer of metals. They're you're seeing the stress in their financial markets with very low inventory levels, and they're jamming margin rates just like the CME is jamming margin rates, and it's not really having that much of an effect on price. So it's a story where basically I think if you do get into global turmoil, you may see cash is king and the deleveraging side start to kick in, where basically the metals have to be sold if you're on leverage. The one thing I am seeing though is this growing increase across the world about borrow against your gold, on the retail level, leasing programs, all these types of things, that maybe that ultimately become a potential trap, and that could create that forced selling. But that's where I see the biggest risk is a
All right,
general market sell-off.
that's good.
Well, if I can, the biggest risk I see floating around is forced liquidation of ETFs of gold.
Forced liquidation in what way?
I need money and I need it now.
So,
So people who buy the ETFs buy it for the liquidity.
yeah. But presumably that only happened in a dislocation of some sort. I mean, as long as prices are going up, not likely to happen. So, no, it's a great question. Ross, did you want to answer the question?
Yeah, I would just agree with what you guys have already said. I mean, if we get into some sort of, especially if the event that you guys were talking about earlier, where this index passive flows unwind and there's just a one-way no bid market, then yeah, I could see precious metals get sold like anything else. I mean, it's when you have to sell what you can, then there's really indiscriminate selling. So, a market dislocation, you could easily see that happen, but no way to be able to predict that really.
I
So
think that's fair. All right, let's keep moving here because I do want to shut this space eventually. I do. Talia Berry, we'll get to Eric and to Deer Point in a second, but Talia Berry, did you want to say something? I saw you had your hand up again, Talia Berry.
Yeah, I'm gonna make this real quick. We've not talked about, the Supreme Court judgment on possibly on Monday on the legality of the tariff. I would like you to kind of touch on that and what the impact would be for the market, gold and silver. Thank you.
All right, I'll try. So I think it would mean more uncertainty, more volatility. The bond market would not like it. So the sources I talk to tell me that they are going to make that decision, but when they're going to make it, I don't know. Many people expect it on Friday, but I think it just means more uncertainty and more volatility. I would caution people from getting too wrapped up in the day-to-day narrative. That is a fool's errand. I mean, I'm not old enough to remember when, April of this past year, when the market, went to zero, and the market really sharply sold off, tariff this, tariff that, whatever. But in the short run, I think it would mean more volatility, probably be a negative for the market. But I don't know that. I think bonds would sell off, but I don't know the effect will be lasting. I don't know if Ross or Bob, you have any thought on that?
Yeah, I don't. What was the question? I guess. Sorry.
Do we think there's going to be a decision on the tariffs? And if the tariffs are, if it suggests that the tariffs are illegal, got to be repealed, what would the effect be on markets?
That would be gold positive, because you basically see the deficit starting to widen again.
Yep.
Demand for debt, or supply of debt would start coming onto the market.
Yep.
The the interesting thing it probably wouldn't be great for the dollar, I would imagine. But I think that's a scenario that I don't think what's interesting with the tariffs on silver, being that that's being under reviewed by the 232 tariff investigation, is if they place tariffs on silver, which I think is probably a small probability event right now, but that would stop the flow of metal going from New York to London, and then that would start to probably turn this backwardation into a huge contango, where basically people now that are short metal, short on the futures contract in New York, now are rushed to get that, either try to cover that short or deliver metal from outside the US into New York if they don't have that metal already in New York. So that's something to kind of watch for on the tariff side.
Ross, you got any thoughts?
No, not really. I mean, it's so hard to predict what's going to happen with the Trump admin and the tariffs. I just think it's better to, like you said, tune out all the noise and just hold. I think you got to hold a core position, and that's your insurance policy. Trying to time when it could be some one-off event is just really hard to do.
Right. That's fair. Okay, where were we? Who was next here? I think Deer Point. Good to see you. What's up?
Good to see you, George. Just a quick question on energy companies, because it was something that I had been doing a little bit of work on and just kind of wanted to field the question. So I was looking at kind of their return on invested capital relative to the weighted average cost of capital. And obviously, you have to kind of take some structural distortions into that as well, trying to normalize any sort of skew in the commodity cycle, et cetera. But overall, what I am seeing in a lot of this is CapEx spending is kind of up in aggregate, but their weighted average cost of capital is greater than the return on invested capital. And so it does seem like, kind of, again, in the aggregate, net present value is either zero or potentially negative on some of these projects. And so, like, for me, I feel like, this might be kind of a essentially a structural issue for energy companies moving higher and probably continuing to not get bid. But I'm not sure if some of the guys who are kind of more into the sector have any ideas. But that's kind of a ratio that I like to look at is return on invested capital relative to weighted average cost of capital, and try to see if they're clearing hurdles. But in the aggregate, it looks like they've been struggling to do so.
Yeah, that's a great point. So I think when it comes to energy, you have to be careful, because there's just a lot of complications when you look at aggregate statistics. And if you take a step back and you look at what happened during the shale revolution, a lot of capital was actually destroyed during that revolution. And I think it's actually really instructive. I think there's a good parallel between what did happen with shale companies versus what's happening with big tech today. In the past, you had conventional drilling, and energy stocks were some of the best performing in the market from the 70s through the early 2000s, before the shale revolution happened. Really solid returns on capital, because the conventional drilling model was very capital efficient compared to shale. And then, of course, all that changed in the shale revolution when the cost to drill these wells just exploded. Much more expensive to drill horizontally through the earth, frack it, pump all kinds of chemicals downhole. And you see that reflected if you just look at a chart of like the XLE, for example, over the decade of the shale revolution. It was just flat returns with a lot of drawdowns and volatility. And so on an aggregate level, most of these companies have been poor performing because it was a race to the bottom where a lot of capital went in and not much came back out. So the reason why I like to focus on the royalty companies is it's a totally different ball game when you just own the surface rights and you basically lease out the land for other people to sink the capital into, and you basically collect a slice of the cash flows on top. So that's my preferred way to invest. And so like the best example of this is look at a chart of Texas Pacific Land, which is ticker TPL. That was far and away, it just blew the shale. It wasn't not just better than any other energy company in the market, but it was actually better than most other stocks in the market. I think it compounded at like 30% per year during the shale revolution when everyone else was struggling to make money. And so that's why I like companies like that. I mean, I think TPL is a great buy here, and companies like VNOM, because they earn much higher returns on capital because they're not pushing all this money down hole to frack wells, and it's just a very hard business to win in unless you're like the top tier operator. Like I would say like a Diamondback is an example of one of the E&Ps that has really high returns on capital. But if you look at an aggregate basis, it is a very low returning industry, and the shale revolution was really a big step backwards in terms of how much money you could earn, even though ironically it created a huge windfall for US consumers and the energy markets in terms of exporting and all the value it created in the economy. All that value went out. That was the problem, is the shale drillers didn't retain any of that value. It all ended up becoming a big consumer surplus. And not to get off on a tangent, but I think that's exactly what's happening with these big tech companies, racing into a much more capital intensive version of what was. It's like George said earlier, AI is basically just a more advanced version of Google search, and now everyone's doing it, and it's 10 times more expensive and maybe marginally more better product, but the companies that are investing in all the capital usually don't see the returns. And so same thing happened with energy. I think you have to be very specific about which companies you invest in, and that's why I think again the royalty companies are really the best bet in that whole space.
Excellent, Ross. Really well said.
Thank
All right, guys, almost 2.5 hours. This has been phenomenal, absolutely phenomenal. We will do this again. Please, everyone, sign up for my Substack. I'm increasingly putting good stuff on there. Also, one last thing I didn't tell you guys. We're going to do another conference in about 2 months, early March. Date hasn't been fixed. We did one last July, and the stock picks were phenomenal. I'm lowering the price significantly to try to get a bigger audience. It'll be $99. You're going to get 15 guys, smart guys, picking stocks, no macro pontification bullshit, the Fed this, the economy that. It's all picks. And it was phenomenal. I actually had someone pick the platinum ETF last July. I think the thing tripled, but no, it's going to be awesome, both longs and shorts. And so there'll be more information coming on that. But it's going to be $99 from some of the smartest guys that and it's all going to be picks, not macro bloviation. So please sign up for the Substack. And there will be a higher value added. There'll be a free and a paid. I'm migrating my content away from X. I just have a love-hate relationship with X, and I will do spaces. Maybe Sunday morning is the best time to do these. Give me feedback. Sunday 11 o'clock, maybe some other time. I don't know. But this has been fantastic. And Ross, I can't thank you enough. Most of the speakers are all gone now, but you were just phenomenal. We'll do this again. Gnostic, as you have done in the past, I'm going to give you the last word.
George,
Yes.
show up more often. I miss you on X's.
Yeah, Gnostic, we got to, if you can explain a way to me where I can be better appreciated and not have to put up with all the crazies on this app, I might be inclined to do it. But I'm just tired of all the bad actors that are on X and all the noise. I mean, it's just become atrocious. So maybe a combination of spaces along with better content on Substack. I don't know, something like that. But I hear you.
Yep, I would second that. I've missed these spaces, George. I think I've said it before. I think you do the best spaces on this platform. So it's been great to see you get back into it. And I hope there's more.
Well, Ross,
Selfishly
I
speaking.
have,
yeah,
George, I have several swear words I'll throw in here to back up what Ross just said. You're missed. Your gruff, nasty voice
yeah,
is just, silk to my ears. Love to hear it. Just hit that mute and kick button
well,
I mean, there's idiots here all over the place, and it's people like you that bring some sanity and old style. I call it old style market knowledge and the rest of the stuff.
yeah.
I mean,
Well,
there's nothing like a floor trader
someone's got to
that can
keep
sit down.
someone's got to keep order in the courtroom. But Ross, seriously, I mean, I don't know. Maybe you and I should co-host some spaces or something because the space is only as good. I mean, listen, I can get on there and talk for an hour. No one wants to hear that. I get bored listening to myself, right? But if we get a good group of people going, like yourself and Coleman and Gnostic and everyone else, then it becomes interesting. So
Yeah,
I don't,
I'd love to.
I don't know, Ross. Like,
Let's
what makes sense to like what? I mean, and also less is more. I think maybe I was doing too much before. Maybe do them just once a week. Maybe people want it more. I don't know. So, like, any thoughts about Gnostic? You too. Any thoughts about frequency or date and time? Like Sunday mornings at 11 o'clock, or I don't know, after the close on Wednesday, or Tuesday nights in the evening. I mean, I don't know. Any thoughts?
I do think the once a week is to me that feels like a nice cadence. And then the reason why I was able to join today is the Sunday is usually I have no one bother me at
Sure.
work or anything, so I can actually join. Um, so I think that's it's kind of a opportunity to review what happened that week. You don't
Yep.
have the craziness of market headlines,
Yep.
and I think it's a good cadence.
Gnostic.
I would agree entirely. And having Deer here, having Ross
Yep.
here, Bob, Rob down there,
Yeah,
some of the,
yeah.
I
Earlier,
mean,
earlier we had Unicus, we had Cantro. I mean, you think about how magical these spaces were 3 years ago, is because we'd have great people come in the room. It's like you go to the local bar and all the usual regulars are there. You know what I'm saying? So if everyone says 11 o'clock Sunday morning seems like a good time, I'm all down for that.
I think it's a great time. I mean, I learned getting my head slapped by the mentors, in the middle of the exchange and all
Sure.
the rest of the stuff. And you just remind me of some of my mentors coming up behind me and going, "Bobby, wake up. Fuck you. Go do this." So I mean, that's in these spaces where you've got all these idiots ranting and raving and doing the rest of the stuff. You need somebody that brings some sort of common, just stop being an idiot sense
Sure.
to the rest of it. And George, that's what you do.
All
And
right.
I'm sorry if you feel like you get the idiots and all the rest of the stuff, but damn it, I miss you.
All right, I miss you guys. Listen, I miss hearing the dulcet tones of your voice, and Ross, it was really great to catch up. And all right, we'll try to do the. All right, so for right here, right now, we'll try to do these Sunday mornings, 11 o'clock. If anyone's got any thoughts about cadence, time, whatever, DM me, send me a message, something. But Sunday mornings at 11 is a good time is a good time for I think for a lot of people because it's downtime. So anyway, with that, enough. So this has been phenomenal. Thank all of you, and hopefully we'll do one next Sunday at 11. Take care, guys.
Thanks, George.
Bye.